Conquer CPA with manifested online classes. We're here to make your CPA journey a success, no matter your learning style. Choose your path to CPA victory. Live Zoom classes. Experience the energy of live learning with expert instructors. It's just like being in the classroom, but from the comfort of your home. Plus, if you miss a class, no worries. You'll have access to class recordings. Live classes are just 4,500 shillings per subject, and our September to December timetable is out now. Classes kick off on September 2nd. To enroll, use paybill 4216C8873 and enter the subject code as your account name. It's that simple. Manifested online classes. Your CPA success story starts here.
So question 1 reads, with reference to alternative dispute resolutions, explain the term arbitration agreement. Because before I consider this question, I'm going to give you an opportunity to attempt. What do you think is the meaning of arbitration agreement? What is the meaning of arbitration agreement? What is the meaning of arbitration agreement? That is question 1A, Roman 1. Question 1A, Roman 1, meaning of arbitration agreement. What is the meaning of arbitration agreement? Laura says it is an agreement that requires people who sign it to resolve any dispute by binding arbitration rather than in court before a judge. Okay. Wafula says is an agreement between two disputing parties agreeing solve disputes outside court. Okay. Silas says is where dispute is submitted by agreement of the parties to one or more arbitrators who makes binding decision on the dispute. Good. The answers that the three of you have given are not bad. Benita says it is a contract in which two or more parties agree to resolve any disputes that may arise between them through arbitration rather than through litigation in court. She goes further to write, arbitration is a private dispute resolution process where the parties present their case to a neutral third party arbitrator or a panel of arbitrators who will then make binding decision on the matter. So she has defined, she says is a contract in which two or more parties agree to resolve any dispute that may arise between them through arbitration rather than through litigation in court. So Perita, up to that point, that's the answer. Okay. Anything that you've said after that is true, but is not necessary. You are not required to define arbitration. You are to define arbitration agreement. Arbitration agreement is a contract, And to put it even more accurate, you can say it is a legally binding contract between two or more parties that stipulates that any future dispute arising between them will be resolved through arbitration rather than through court litigation. Okay? So you see, your answers were not far off from the truth. So it is a legally binding contract between two or more parties. So if you are to get into a relationship with you, say business relationship, okay? Or maybe we are partners in a business. So before we begin the business, we enter into an agreement, a legally binding agreement or contract, stipulating that as we begin our contract today, any disputes that will arise from today's henceforth will be resolved through an arbitrator, that is a third party, rather than through court litigation. So the parties agree that in case they have any problem among themselves, they not go to court, but they look for a third party to resolve the dispute. You understand? A legally binding contract or Candace, before I write, can you write what I've just said? Define it. Write down what I've just said. I've defined it. Can you please write down the definition? If you have written it, just refine it. Write down on paper what I've just said. That's how we revise. You try to recall in your memory. That writing also helps you to reinforce what you have heard. So put down the definition in your notebook. It is a legally binding contract between two or more parties. Okay? Between two or more parties that stipulates, okay, that any future disputes, any future disagreements or disputes will be resolved through arbitration and not through court litigation. That is the meaning of arbitration agreement. Wafula asks, why only future disputes? I think also current or past disputes or disputes on specific matters can be resolved through arbitration. That's not the question, Wafula. What you are saying may be true, but you are defining an arbitration agreement. It is a contract. If I was to enter into a contract with you regarding, if you are in, say, I gave an example of a business relationship. If you are starting or engaging in a business relationship, then what you are agreeing on today can only affect future disputes. Do you understand the context? So it's, if there are past, if we've been in a relationship with you and there are past disagreements, you see the disagreements happened before we had an arbitration agreement. All right, unless we agree with you that the disputes you had in the past, we let us not go to court. Right? But the very definition of an arbitration agreement is just an agreement between two or more parties. You agree in advance that any dispute that you are going to have will not be resolved in a court of law, but through an arbitrator. Do you understand the difference? So arbitration agreements are deliberate agreement between parties who are entering into different kind of relationships. Could be business relationships. So you agree in advance. Okay, you agree in advance that in case we may have disagreements, let our disagreements be resolved by a third party. Do you understand? Yes, but we can form the agreement when the dispute rises. Like we have a dispute today, we can enter into a contract to resolve it through. So Wafula, if we have an agreement today, if we have a disagreement today, we do not need a arbitration agreement to resolve it. If both of us have agreed, we are not going to court. We don't need an agreement to that effect. You understand? If we are having a relationship with you and both of us have agreed that let us resolve this matter outside the court, we don't need to do an agreement because we already agreed. Do you understand the difference? There is no point of having an arbitration agreement to resolve a matter that we've already agreed upon. If we already agreed that we are not going to court, then what is the point of having an arbitration agreement? So arbitration agreements are only relevant or only take place when there are no disputes. So you agree in advance that in case there will be any future disputes, we will not go to court. You understand the difference? Wafula says, I think that agreement is the contract. Like we had a case in court with my employer. We decided to resolve it through arbitration where we had a third party. Yeah, there was a previous disagreement. We decided to solve it through arbitration. Did you, in that case, Wafula, enter into an arbitration agreement? You agreed. If parties agree, my point is, if we have agreed that we are not going to court, it is not necessary to have it on paper as an agreement that we are not going to court. Because we are not under aggregation, we are not under any obligation to to write it or to go to court. If an agreement can be just verbal. Okay? You understand the difference? You can agree, because these are private matters. Okay? You can agree with whether it is an employer or a business partner not to go to court. So the agreement is could be related to past, as you are saying, but it's not necessary to have it in writing that you are not going to court. You can just decide not to move to court and work out your disagreements. And you are right, an agreement is the contract. So let's move on to the next part of the question. Outline 6 matters which may not be referred to or determined through arbitration. Outline 6 matters which may not be referred to or be determined through arbitration. What is your take? Wafula says murder case. Murder case. Any other matter? Now, Wafula, the better way to put it, other than saying murder case, a murder case is murder is a crime. So instead of just saying murder, the best way to write it is to say criminal matter or matters. Criminal matters. You understand? Murder is a crime. So criminal matters which involve actions against the state, they carry potential penalties such as imprisonment, which are generally not subject to arbitration. You understand, Wafula? Criminal matters. It's not just murder. It could be rape and any other crime. Robbery with violence, such matters cannot be referred to arbitration. So the first matter you write, this is Roman 2, matters not referred to arbitration. 1, criminal matters. And I've explained why criminal matters cannot be determined through arbitration. Okay? Silas says guardianship. Panu says matters relating to violation of human rights. Laura says matters relating to interpretation of the Constitution. Silas says insolvency petitions. Insolvency petitions. Apollo says public interest issues. Laura says election disputes. Laura, election disputes are not resolved through arbitration. They are resolved through legal processes. within established the court system. If you are old enough, you recall the presidential disputes that have happened in Kenya. Other parliamentary, we've also had disputes. All the disputes must be determined according to the law through the court system, not through arbitration. But if you have specific circumstances relating to elections, like internal party disputes, you understand? Some political parties may use arbitration to resolve internal disputes. Because their constitutions may have arbitration as one way to resolve disputes. Perita says employment matters. That is true. Public intellectual property disputes. Laura says matters relating to interpretation of the constitution. That the matters relating to interpretation, candidates are hard. If you've been studying administrative law or administration of law in Kenya, the High Court is a court that has been vested with the jurisdiction of interpreting the constitution. It cannot be resolved through arbitration. Perita says intellectual property disputes. That is a matter not referred to arbitration. Intellectual property disputes. Intellectual property disputes. Okay? Intellectual property disputes cannot be resolved through arbitration. Intellectual property disputes, or disputes involving, we can say disputes involving intellectual property rights. You understand? Those cannot be resolved through arbitration. Then we have public interest issues. That is true of Wafula. Public interest issues. Public interest issues. Public interest resolving matters of significant public interest, such as environmental protection, such as public health, matters such as consumer rights. Those are examples of public interest issues. Such matters may be excluded from arbitration to ensure that they are resolved in a transparent and accountable manner through a court system. Public interest issues or matters. Benina says criminal matters. That is true. That was our first point. Hanu, public issue matters. Hanu, that is public interest matters or issues. Public interest. Then we have employment matters. Employment matters. Is it true? Someone just told us they resolved an employment matter in court. Who was it? Wafula? Wafula told us that he had a case in court with his employer, and they decided to resolve it through arbitration. Wanja says bankruptcy disputes. Bankruptcy disputes. So that is bankruptcy or insolvency proceedings. Bankruptcy or insolvency proceedings. These are issues that are related to insolvency and bankruptcy, such as the winding up of a company, or the distribution of assets among creditors. These are generally handled through specific legal processes and are not suitable for arbitration, bankruptcy, or insolvency proceedings. Okay? Let's analyze any other points here. We have, I saw something like guardianship. Guardianship. Someone said guardianship. What was it? Family disputes. Yeah, that's true, Anja. Silas says guardianship, then there is family disputes. The right word there is matrimonial disputes. Matrimonial disputes. Matrimonial disputes. Matters relating to divorce, matters relating to separation, matters relating to child custody, and even maintenance are typically excluded from arbitration because they involve sensitive family issues that require the oversight of a specialized family court. You understand? And the reason why some of these matters cannot be resolved through arbitration, like matrimonial disputes, because some of the matters require specialized attention, and we know arbitrators are not required to be specialized professionals. You understand? We can agree with you to appoint anyone to be our arbitrator to resolve our dispute. That anyone may not have the required skills, knowledge, and training to resolve all disputes. That's why there are certain matters that cannot be resolved through arbitration. And one example is insolvency is not an easy matter. Bankruptcy proceedings can only be heard by the courts, by the judges who are trained to resolve such disputes. You understand? So these are 1, 2, 3, 4, 5. Give me another one, please. Give me another matter. Someone says here, matters relating to violation of human rights. Matters relating to violation. Hanu says matters relating to violation of human rights. Hanu, matters relating to the violation of human rights are not typically referred to arbitration because human rights are fundamental. Human rights are unalienable and are considered to be of public importance. They are not matters to be negotiated or even compromised in private proceedings like arbitration. Furthermore, countries or states have the primary responsibility to protect and promote human rights. So when these rights are violated, it is generally expected that the state institutions, particularly the courts, must handle such matters. So matters relating to violation of human rights cannot be referred to arbitration. Do you understand, Hanu? One just says consumer protection cases. Consumer protection cases, Wanja, we argued that under, what was it, public interest issue. That is a public interest issue. That is point number 3 on the board. How many points were we to give? We are to give 6 matters. Please give me the 6th matter. There's someone who mentioned employment disputes. Employment disputes. Employment disputes. Candidates here in Kenya, while some employment disputes can be referred to arbitration, there are certain matters such as unfair termination, matters such as discrimination in employment, matters such as sexual harassment. Such matters are excluded and fall under the jurisdiction of Employment and Labor Relations Court. Okay? You understand? There are certain matters relating to employment disputes that may be referred to arbitration. But the examples I've given, like sexual harassment, unfair termination, discrimination, such employment disputes can be referred to arbitration. So these are 6 matters that cannot be referred to arbitration. 1, 2, 3, 4, 5, 6. Is that clear? Part B of this question reads, in relation to the tort of nuisance, differentiate between private nuisance and public nuisance. 4 marks. And as we know, a tort is a civil wrong, and one such civil wrong is nuisance. There are 2 types of nuisance: private nuisance and public nuisance. What is your take on that? Without referring to your notes. Private affects an individual, while public affects a large number or the whole community. That is true. That is true. Differentiate between, this is part B. Differentiate between private and public nuisance. Someone else try? 4 marks are added here. Candidates, how many points or distinctions do you think are needed for you to earn the 4 marks? Or full? What do you think? How many points? Because the examiner is not clear on how many distinctions you have to provide to earn the 4 marks. So what do you do in an exam room? How many distinctions do you give? If you are being told to distinguish 2 terms like these ones, and you are awarded 4 marks. I'm waiting for you to answer that question. Correct. 2 points are enough for you to earn the 4 marks. So you have public, and candidates, when you have terms to distinguish, please present the differences in a columnar format so that you have public nuisance, private nuisance. It's good to have the distinctions in a columnar format. And why do you think candidates presenting the answers in columns is better than presenting the answers in paragraphs. Why do you think it is desirable to have the answers in columns? Can someone answer me that? One reason is that when you present the answers in columns like this, the way I've demonstrated here, it becomes easier for the one who is marking to see the distinctions. Your answers become marker friendly. Okay, so you can have one column for the basis of the difference, then you have the two terms. And one basis for distinguishing terms is just by definition. If you define private nuisance and define public nuisance, that definition will bring out one difference. So a private nuisance is an unlawful interference with a person's use or enjoyment of their land or some right. Do you understand? Wafula had mentioned that it affects an individual. But to put it more accurately, Wafula, private nuisance is an unlawful interference. Being a nuisance is to unlawfully interfere with a person's enjoyment of their right. You understand? It's unlawful interference of an individual's enjoyment of right. You understand? Private nuisance, I repeat, is an unlawful interference with a person's enjoyment, okay? Interference of a person's or an individual's enjoyment of some right. So you can be a nuisance to an individual, or you can be a nuisance to the general public. You understand? So nuisance may affect just an individual or a group of individuals, many individuals, or the public. Public nuisance, that is to say, is an act or omission that materially affects the reasonable comfort and convenience of the members of the public. Do you understand? So that is one definition or distinction based on definition. Now the second distinction can be based on the scope of nuisance. Scope of nuisance, or let me say scope of impact. Scope of impact. You can distinguish the two by identifying the scope of impact. The scope. Here we have said that the nuisance only affects an individual, whereas the public nuisance affects a class of people or a community as a whole. This one affects an individual. This one affects a class of people or community. For example, if you are playing loud music in your house, you can maybe unlawfully interfere with your immediate neighbors' enjoyment of their right to peaceful environment, or your music can affect the whole community. If it's too loud, it can affect a larger group of individuals in a community scope. You understand? So these are two differences. Another distinction can be based on the one who standing, like let me say standing to sue. Standing to sue. Standing to sue. For private nuisance, only the person with an interest in the affected land, okay, can sue. Only this individual who is affected by this private nuisance can sue. But in public nuisance, on the other hand, candidates, public nuisance, an individual can only sue if they have suffered special damage beyond that of the general public. Do you get the difference? We can distinguish private nuisance from public nuisance by looking at the persons who stand to sue, who have a right to sue. Those who have a right to sue. And I've said that in private nuisance, only the person with an interest in the affected land can sue. Whereas in public nuisance, candidates, an individual can only sue if they have suffered special damage beyond that of the general public. Okay? Otherwise, it is the Attorney General, or even the Attorney General who typically brings action in public nuisance. But if it's an individual who has suffered more damage than the rest of the members of the public, and there is evidence to that effect, then such an individual can sue for matters relating to public nuisance. You are to give 2 candidates, but I'm giving more because you may be required, maybe in your paper, to give 4 distinctions. Another basis for distinction is focus. Focus. The focus. Private nuisance focuses on the interference of an individual's property rights. Okay? Individuals. It focuses on an individual's rights. Okay? Individual's property rights. That is private nuisance. Whereas public nuisance concerns the interference of public rights. It is concerned with the interference of public rights. Focuses on the interference with individual rights, whereas public nuisance concerns with the interference with the public rights and interests. And of course, examples of private nuisance include playing loud music, okay? Loud music, loud noise from a neighbor's property. It could be foul smell. If there is a dog or a cat that has died in your compound and is emitting foul smell that can constitute nuisance. Okay? Or even noise from a nearby factory that can constitute. Another example could be just even branches of a tree hanging over your neighbor's fence, okay, damaging property in your neighbor's compound. That is an example of private nuisance. Examples of public nuisance include obstructing the public highway. If you obstruct the road, obstruction, that is an example of public nuisance, right? Obstruction, when you obstruct the users of a road. Or polluting a river that is affecting a community. If you pollute a river that is used by many members of the community, that is public nuisance. Carrying out dangerous activities, okay, which poses a risk to the public, that constitutes public nuisance. So these are a few distinctions of private and public nuisance. Do you understand? Is that clear? B Roman 2. Discuss 4 defenses to the tort of nuisance. Defenses to the tort of nuisance. Defenses to the tort of nuisance. If you are accused in a court of law of nuisance, how will you defend yourself? That's what the question is requiring us to answer. What do you think? What do you think, Silas? Laura says inevitable accidents. Wafula says consent, like the person was aware or unaware. All right. Now, one obvious defense is statutory authority. Statutory authority. Statutory authority may be used as a defense to the tort of nuisance. If the alleged nuisance is authorized by a statute or legislation, because that's the meaning of statutory. Statute is an act of parliament or legislation. If there is an act of parliament that gives one the authority to engage in the act, then that can be used as a defense. If the alleged nuisance is authorized by a statute or legislation, it can serve as a defense. However, the defendant must demonstrate that the nuisance is an inevitable consequence of the authorized activity, and that all reasonable precautions were taken to minimize the impact. You understand? That is one defense. Another defense is what we call prescription. 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 That is to mean if the nuisance has been going on for a continuous period of time without any objection from the claimant, then the defendant may acquire what we call a prescriptive right to continue the activity. Prescriptive right. If the defendant has been doing the thing over a long period of time and no one has complained, then when this defendant is taken to court, the defendant can acquire what we call a prescriptive right. And that is a defense. Now, a prescriptive right allows the defendant to continue the activity even if it causes nuisance. Why? Because they would have acquired a legal right to do so through the long usage. So if you have been engaging in an activity that may be considered nuisance and no one has been complaining for a long period of time, say 20 years or so, then you can obtain a prescriptive right to continue doing the activity, and that right acts as your defense, so that if anyone runs to court to accuse you of nuisance, you can now use it as a defense, because such defense essentially legalizes the nuisance due to its long-standing existence. You understand? That's what we mean by prescription. That's a defense to the tort of nuisance. All right? Another defense is what we call coming to the nuisance. Coming to the nuisance. Coming to the nuisance. What does that mean? Now, if the claimant, and here the claimant is the one who accuses another for nuisance. If the claimant knowingly moved into an area where the nuisance already existed, they may have a weaker claim in a court of law. If you moved into an area and there is a lot of noise, knowing there is noise, and you accuse the one who is producing the noise, you came to the nuisance. The defendant can use that as a defense, that the claimant came to the nuisance. But you have to understand that the coming to nuisance defense is not absolute. It is not what? Absolute. That is to mean that the court will consider the nature and the extent of the nuisance, as well as the reasonableness of the defendant's conduct. It is not guaranteed that the court will grant you this defense. It's not absolute. But you understand? Coming to the nuisance. The fourth defense is what we call public benefit. Public benefit. Public benefit. If candidates, in some cases, the defendant may argue that the activity causing the nuisance provides a significant public benefit that outweighs the harm caused by the claimant. You understand? Public benefit. And such defense is often used in cases involving infrastructure projects or essential services. But here, just like the coming to the defense, the court will also carefully balance the public benefit against the individual harm suffered. You understand? Yes. So these are four defenses to the tort of nuisance: statutory authority, prescription, coming to the nuisance, public benefit. So candidates, when answering this question, these questions, you may not necessarily have to use the words I'm using. You can paraphrase these words, just like Wafula has been doing and the rest of you. Okay? We've answered question 1. Bye-bye.
Hi there, my student. Welcome to Manifested Online Classes. My name is Joseph Kemani. So in this session, I want us to look on illustration question on preparation or presentation of a statement of cash flows. And I want us to go through that particular question, and then we see what was required. So the question reads, Rilongwe Limited is a public listed company. Details of the company statement of financial position as at 31st of March 2022 and 31st of March 2023 are shown below, together with other relevant information. So we have the statement of financial position as at 31st of March 2023 and 31st of March 2022. So we have non-current assets, which include property, plant and equipment, intangible assets, and then other current asset we have inventory, trade receivables, interest receivable, short-term deposits, and then we have bank. Under share capital and reserves, we have ordinary share capital, and then reserves include share premium, revaluation reserve, and then we have retained earnings. Then we have the total equity. We have non-current liabilities, which include 12% raw notes, 8% variable rates raw notes, and then we have deferred tax. Under current liabilities, we have trade payables, bank overdraft, and then we have what? Taxation. And then we have some additional information, number 1, 2, 3, 4, 5. And then what are we required in our question here? We are required to prepare a statement of cash flows for Rilongwe Limited for the year which ended 31st of March 2023 in line with International Accounting Standard number 7, which governs the presentation of the statement of what? Cash flow. Now, first of all, if you check on this particular question here, the examiner had not specified which method you should use in preparing that particular statement of what? Cash flows. But generally, anytime you come across a question for cash flows and you are given the income statement, you are given the statement of financial position, always use the indirect what? Method, unless otherwise what? Required on, unless otherwise what? Stated. So therefore, in this case, we are going to prepare now our statement of cash flows using what? Using the indirect method. But before you do that, I want us to go through the additional information, and basically we see whether there are some workings which are required as far as that particular question is concerned. So let's go through the additional information. We see what you're told. Number 1, you're told details of property, plant and equipment as at 31st of March 2023. Basically, that is the end of the current financial year, and therefore those are the closing balances. And then 31st of March 2022. 31st March of 2022 is basically the end of the previous year, in which case those balances at the end of the previous year will be the opening balances in the current what? Year. So we are given 3 items for each year: the cost stroke valuation, the depreciation, the carrying amount. And then we are given that for 100 buildings and plant and what? And plant. So basically what that means is that the property, plant and equipment, which is in our statement of financial position, comprised of 2 assets: landed buildings, plant, and then we are given their what? Their cost, the accumulated depreciation, their net book value, both at the start and also at the end. So no working which is required at this point, but we may be required to come back to that note. Let's move to note number 2. We are told the company revalued the carrying value of land and buildings by an increase of 70 million on 1st of April 2022. So 1st April 2022 is automatically the start of the current year, because the current year ended 31st of March 2023. That year started on 1st of what? April. And therefore, you're told land and buildings were revalued upward. And there was a revaluation gain of what? 70 million. And then you're told in the other sentence, on 31st of March 2023, that is now at the end of the year, the company transferred shillings 3 million from revaluation reserve to the retained earnings relating to depreciation on revaluation of buildings. Equally, no working which is required as far as that point is concerned. In note number 3, we are told during the year the company acquired a new plant at a cost of shilling 60 million and sold some old plant for shillings 15 million, incurring a loss of 12 million. So in that point, we are given two transactions. One, there was a new plant which was acquired, and you have now to remember any activity relating to acquisition and disposal of asset, this is an investing activity. So therefore, in preparing our statement of cash flow, this plant which was acquired will be one of the item you're going to take into account in computing the cash flow from investing activities. Also in the same note, we are told there were some old plant which were disposed. Remember, what you have said is that once the company sells an item of PP, you have to prepare what? The disposal account. And in this case, as per the information which is given there, we are given the sales proceeds because you are told that old plant was sold for 15 million. That is the sales proceeds. And also now we have what? We have the loss on disposal, which is how much? 12 million. Anytime you see the examiner having given you the gain or the loss on disposal, then there is an item which the examiner may not have given you. So therefore, I think we can start by preparing that particular account there, which is the disposal account. Disposal account. Disposal account. So remember, I've said that in preparing this account, on this side we record the cost of the asset which was disposed. On the credit side we record the accumulated depreciation and the sales what? The sales proceeds. And then the balancing figure in this account we have said will be a gain or a loss. But in that point we are told that this item was disposed at a loss. So we already given the loss, and the loss in our case is how much? Is 12 million. So and all our figures are in million of shillings. So for us to be consistent, we are going to work with all our figures in million of shillings. And then which other item are we given here? We are given the sales proceeds. We are told it was disposed at an amount of what? 15. So if you check on the information which is given there, we are not given the accumulated depreciation. Equally, we are not given what? The cost of that particular what? Item. So, but we will see how to determine those particular what? Values there. Okay, before we go to note number 4 there, and also note 5, 6, there are a number of accounts maybe we can prepare here relating now to the PP. Relating to what? To the PP. For example, from the information we have in note number 1, we can open a number of accounts there. We can open the account for added buildings. We can open the account for plant, because there are a number of items which we must compute here and which are not given. So let's start with the account for what? The account for plant. Plant account. Plant what? Account. And for this particular account, we are going to prepare it at cost. So if we prepare that account at cost, we have now to prepare a separate account for something called the accumulated depreciation. Accumulated depreciation on what? On plant account. We also prepare that particular account here, this account, and also we prepare the other account that is for land and what? Buildings. Land and buildings account. As you are going to see, there are a number of items we are going to determine by preparing this account. So the first thing we need to record here, remember I've said this account will be prepared at cost. Prepared at what? Cost. So what we need to do is to record the cost of the plant at the start of the other. This is in note number 1. So what is the cost of the plant at the start? The cost stroke valuation. Remember I've said what you're given as the balances on 31st of March 2022. These are opening balances. 31st March 2023, these are the closing what? Balances. So the cost stroke valuation of a plant at the start of the year is 445, 445. What about at the end of the year? The end of the year is 440. Is 4 what? 40. That is balance carried down. Balance carried down, which is 440. Then we record the accumulated depreciation both at the start and at the end. Now the accumulated depreciation, this account do have a credit balance because this is a provision account. So what is the accumulated depreciation on plant at the start of the year? It was 105. It was 105, and the accumulated depreciation for plant at the end of the year, which will be on this side, is an amount of what? 148. 148. So then we also do the same for building. For building, what was the cost stroke valuation of buildings at the start? It was 500, and then at the end of the year, it was how much? It was 600. It was 600. It was 600. Yes. So that's basically what we have in note number 1. And then can we go to note number 2? In note number 2, we are told that the company revalued the carrying amount of landed buildings by an increase of 70 million on 1st of April. So basically what that means is that these particular landed buildings, they were revalued at the start. They were revalued at the start. It is important to note that once the assets have been revalued at the start of the year, then the depreciation for the current year will be computed based on the revalued amount. Based on the revalued what? Amount. And therefore what we do is that we ignore the previous accumulated depreciations. We ignore the previous accumulated what? Depreciations. For example, in note number 1, I hope you can see the depreciation which are given there for landed buildings for the current year. That is 31st of March 2023. Now that amount of 12 depreciation for landed buildings, that is the depreciation for the current year, because I've said that depreciation was computed based on the revalued amount. Once the assets have been revalued, the depreciation for current year we computed based on the revalued amount, and the previous accumulated depreciation are ignored. That's why we are not preparing the accumulated depreciation account on land and what? A building, simply because I've said that the depreciation for the current year for land and buildings was computed based on the revalued amount. In fact, I've said that amount which we have there for the current year, the depreciation on landed buildings for the current year, the amount of 12 million is the depreciation for the current year. So what we need to do then, can we go to note number 2? Note number 2, we are told landed buildings were revalued upward with an amount of 70. Generally, remember what you have said is that in preparing any asset account, there are a number of items you should record here. Like in this case, you have said any revaluation gain recorded on this side, and any disposal of asset, and take into account this account we are preparing it at cost. We are going to have now the asset which were disposed at cost. At what? Cost. And take into account also this account is at cost. Depreciation is not recorded here, but it should be on this account here. So the depreciation for the current financial year for plant should be the balancing figure there. I don't think we have that figure. That is one of the items definitely we need to compute. Then on this account we should have any revaluation gain, and basically we know that during the current year landed buildings were revalued upward with an amount of how much? 70. And then what we should have on this side is any disposal. Any what? Disposal. Well, there are some items of landed buildings which were disposed. Are we given such? I don't think so. I don't think we have such disposal. I don't think we have any disposal on land and what? Land and buildings. So, but we have a revaluation gain of what? Of 70. Yes. So that's what we have in note number 2. But also in note number 3, we have this new plant which was acquired. So a new plant which is acquired, remember for plant and equipment, okay, for plant there was no any revaluation gain, but you are given the acquisition. The acquisition is an amount of how much? The new plant acquired had a cost of how much? Had a cost of 60. But I think that's what you're given in note number 2. So as far as that plant which was disposed is concerned, you can see we are only given the sales proceed and also what? The loss on disposal. The loss on what? The loss on disposal. The loss on disposal. Yes. So that I think what we have. So what we need to do now, I think we can start by balancing these two accounts here, these two accounts. So of which you can see what we don't have here is now this disposal. And basically this disposal is what we are going to record here. This is a cost of this item which was disposed and which are not given there. So therefore, can we do that? What we have on the debit side is 445 plus 60. That will give us 505 minus what we have on the credit side, that is 440. So that will give us 65. So basically it means that this item of plant which was disposed, it had a cost of 65. It had a cost of what? 65. And automatically, then we can get the balancing figure here, which represent the accumulated depreciation of that item which was disposed. So we take 65 minus what we have on the credit side, 15 and 12. So that will give us 38. So this is the accumulated depreciation of the plant which was disposed. Now this particular accumulated depreciation, the figure of 38, then we should bring it to this account because this is part of this opening balance and that plant was disposed. So we have the accumulated depreciation for the item of plant which was disposed. How much is that? Is 38. Then we balance this account. The balancing figure here represent the depreciation for the current financial year and which was taken to the income statement. What we have on the debit side is 148 plus 38 minus what we have on the credit 105, so which will give us 81. So this 81 now represent the depreciation for the current year, year. We also need to balance this account and basically the balancing figure in this account will be the acquisitions, because in our case here we don't have any disposal. Anytime there are some items of PP which were disposed, you must be given that particular information. So in our case we don't have any disposal, and then because we are preparing this particular account also at cost, we don't have to credit the depreciation on this side. But there is a figure which I think I recorded the wrong figure here. So this is the closing balance. So I need to record the opening balance, which was how much? Which was 420. Yes, 420. And then from there, what we need to do is basically we balance that account. So let's balance that account. We see what will be the balancing figure. What we have on the credit side is 600 minus what we have on this other side, 420 and 70. So we are going to have a balancing figure here of 110. So this 110 represent now the items of or basically represent landed buildings which were acquired during the current year. So I think we are through with that additional information, number 1, number 2, and also number 3. So let's move to note number 4. Note number 4, you are given the statement of profit or loss. I don't think we have any working which is required as far as that is concerned. There was an operating loss, interest receivable, finance cost, loss before tax, income tax, repayment claim, and then we have the deferred tax charge, and then we are told we are given the loss for the period, and then you are told the finance cost. The finance cost is which we have in the income statement up there, the figure of 24. It included the interest expense and also the penalty on early redemption. So this penalty on early redemption is basically a penalty which was which the company paid to the bondholders for redeeming the loan notes early. So basically this is not an operating expense, and therefore when computing now the cash flow from operating activities, we are going to add it back to our profit or basically to our loss because it's not an operating expense. And then number 5, we are told the short-term deposits are deemed to be cash equivalents. And then number 5, we are told the dividends paid by the company amounted to what? 25 million. So I think no workings which are required, and I think now with that we can go straight to what is required. We prepare our statement of what? Cash flow. So we need to have the title here. The name of the company is Lilongwe Limited, and this is a statement of cash flows. A statement of cash flows, which is for the year, which ended 31st of March 2023. 2023. Remember, in this case here, the examiner had not specified which method to use, but I've said once you're given the income statement and also the statement of financial position, then always use the what? The indirect method. Use the indirect method. So here we start by determining the cash flows from operating activities. From operating activities, we need to have two columns, and our figures are in million of shillings. Our figures are in millions of what? Of shillings. So what do we start with here? I said we start with a profit before tax. But if you check on what you're given in the income statement of this company, in the additional information number 4, we are not given the profit before tax, but we have the loss before tax. That's what we start with here. The loss before what? Before tax. Before tax, how much is that? Is a figure of 44, and because it's a loss, we record it there as a negative. We record it there as a negative, and then we make a number of adjustments to this particular what? To this particular loss. And the first adjustment, recall what we said when we were looking on the format. We say the first adjustment you make to this particular profit or loss is the finance cost, because essentially I said you should start with the profit before interest and tax, or the loss before interest and tax. But because you'll not be given that, start with what you're given, that is the profit or the loss before tax. The first item we need to adjust to our profit there is the finance cost or interest. The reason why we do that is for us now to have the profit before interest and tax. Now that is given in note number 4. In note number 4, just before, above the loss before tax, we have the finance cost, which is 24. Which is 24. We add it back to that, so that now we have the loss before interest and tax. And then we have said to this particular profit here, when using the indirect method, basically there are a number of items we adjust to that profit, and I gave you a certain acronym which you can use in terms of remembering those items. Dial G, you check for depreciation, any impairment, loss on goodwill, any amortization on intangible asset, any loss on disposal, and the gain on disposal. And I think in our case we have a number of items. So first of all, we have the depreciation. So for the depreciation, we have the depreciation for what? For plant. For plant. And basically that is what you have determined here. We have depreciation, the depreciation on plant. How much is that? Is a figure of 81, because that was deducted in arriving at that particular profit. Add it back. And then the depreciation on land and buildings. So this is in note number 1. That depreciation for the current financial year for added building, that is a figure for 12. I've said that is a depreciation for the current year. Take into account our ad and buildings were revalued at the start. So meaning that the depreciation for the current year was computed based on the revalued amount. How much is that? 12. We add it back to that because it was deducted and is a non-cash item. So we have captured this depreciation on a plant. We have also taken into account depreciation of what? Land and building. So we don't have any other depreciation. So what else do we have here? We also have the loss on disposal. This one. So we have the loss on disposal. And this is the loss on disposal of plant. Still an amount of 12. That was deducted in arriving at our loss there. Add it back. So I think that's what we have here. So do we have gain on disposal? No. Do we have amortization of intangible asset? Amortization of intangible asset? Yes. In this question here, if we go back to where we have the non-current asset, in the statement of financial position, under the non-current asset, you can see we have two assets, PP, property, plant and equipment, and then intangible asset. What was the value for intangible asset at the start? It was 510. But at the end of the year, the value for intangible asset reduced to 400. What causes the value of an asset to reduce? It can either be disposal or amortization in case of intangible asset. And because there was no disposal, basically I've said anytime the company sells some asset, you must be given that information. So that decrease for intangible asset automatically is what? Is amortization of what? Of intangible. Amortization of intangible assets. And that is a figure of 110, which is now the decrease. Equally, we add it back now to the profit there because it was deducted, but is a non-cash item. So I think that's what we have. In our case, do we have impairment loss? No, we don't have that. So I think those are some of the items which we have from our acronym THEODILE-G. But I think before we consider the changes in working capital, if you go back to the income statement which we have in note number 4, you'll be able to see that in arriving at that loss of 44, there was a finance cost which is above that, and then you can see there is interest receivable. This interest receivable, you have said that this is a form of an investment income. In arriving at this particular loss, there is the interest receivable, which was deducted, but this interest receivable is not what? Is not an income from operation. So therefore, because it was added in arriving at that, what we do, we less it. I think that's what we have in note 4, note 5, note 6, no adjustment here. And then I think we have captured most of the items in note number, actually all items which need to be adjusted in our profit, note 1, note 2, and also note 3. So what we need to do here is to get something known as cash flow before changes in working capital. Cash flows before changes in working capital. And then from there we consider the changes in working capital. The changes in working capital. So let's compute that figure there. That is cash flow before changes in working capital. So we need to work out of that. So we have negative 44 plus 24 plus 81 plus 12 plus another 12 plus 110 plus 110 and then minus 12, and that will give us what? That will give us a figure of 183. So that we refer to it as what? The cash flows before changes in what? Before changes in working capital. Before changes in working capital. And then from there we consider the changes in working capital. For the changes in working capital, here we said we consider 3 items. You just need to remember this, RIP, not less in P's, but we consider receivables, inventory, and what? Payables. So you just determine, was there an increase or decrease? These always 3 marks in an exam setup, in an exam. So therefore what you do, you go to where we have current asset, consider 2 items there, receivables and inventory, and then other current liabilities we consider payables. So let's go back to the statement of financial position given under paragraph 1. We consider what? Inventory. So we just need to determine for inventory, was there an increase or decrease? And inventory at the start for 20, at the end 350. So in that case we can see we have a decrease. Decrease in what? In inventory. What causes inventory to reduce? Because the company disposed or basically sold inventory. So the decrease is 70. What about receivables? Receivables increased. So therefore this decrease in inventory is a cash inflow because inventory reduces, that is, inventory decreases because inventory was sold. And then we have increase in trade receivables. Increase in trade receivables means that we extended more credit to our customers. If we give our customers some credit, it is basically a cash what? A cash outflow. So let's determine the increase there. So the receivables increase from 372 to 808. That is an increase of what? Of 436. And I've said this means that we give our customer some credit. If we give our customer some credit, what is that? That is a cash outflow. Yes, I think that's what we consider here. And then we go to where we have payables, we consider, or to where we have current liabilities, we consider payables. And I can see also for payables, we have an increase in trade payables. The trade payables increased from 515 to 530. That is an increase of 15. Increase of 15 in payables of 15 million means that our suppliers, our creditors extended more credit to us. That is a cash what? Is a cash inflow. Yes. Then what we need to do, we basically get the rent amount, we take it to the last column here. So we have 70 minus 436 plus 15 plus 15 plus 15 plus 15, which will give us negative 351. So we deducted from the figure up there, the figure of 183, which is 168, and which is a negative. And then to this, we have said from the format I gave you, we less the tax paid and also the interest. The interest paid. So I think here we can start with the interest. Remember, you said interest is another name for finance cost paid. Finance cost paid. So in determining the finance cost, or basically the interest which was paid, here you consider two items. One, the finance cost in the income statement. I hope you can remember that figure in note 4, which is a figure of 24. And then you go to where we have current liabilities. In your statement of financial position, you check, was there any accrued interest at the start and also at the end? At the current liabilities, we don't have such. But if you had accrued interest at the start, what you do, you take the accrued interest at the start, which we don't have, then add the interest or the finance cost in the income statement in note number 4, which is 24. But we also have to remember, we are given a breakdown for that finance cost down there. A finance cost, we are told, include the penalty on loan redemption. That penalty, we are not going to consider it here. We only consider, we take into account the figure of 18. So we add 18. After adding the two, the accrued interest at the start and the interest for the current year, which is in the income statement, less the accrued interest at the end. And basically that will give you what? The interest, which was paid. But now for this tax here, we have to prepare something called the tax account. Remember, we have looked on the format for this. So therefore, we have to prepare that account to determine how much tax was paid during the current what? Year. So let's prepare that account here. The taxation account. Remember, you have looked on the format for this, and I've said in this account what we record is the deferred tax at the start, the current tax at what? At the start of the year, and also we record the same at the end. The deferred tax, current tax at the end. So the deferred tax and the current tax, this is part of the liability. So can we first of all go to where we have non-current liabilities? Yes. Under the non-current liabilities, I can see we have a deferred tax at the start of 75. At the end, we have a deferred tax of what? Of 90. At the current liabilities, we have taxation. Taxation, that what in other terms we refer to as current tax. At the start, 110. And then at the end of the year, this 90 is the deferred tax. The current tax at the end of the year was 15. So then we take into account the tax for the year. So can we go to where we have income statement in note number 4? In note number 4, just below the loss before tax, we have income tax repayment claim. So this is an income tax repayment claim. This is not a tax expense, but this is now what the company was claiming to be refunded by the government. So that item, we basically record it on this side. Income tax what? A claim. But if it was an income tax expense, then we record it on which side? On the debit side. I hope you're together on that. So therefore, the income tax claim is 14. And then below that, we also have something called a deferred tax charge. A deferred tax charge, you can see there is a negative, meaning that this is a deferred tax what? Expense. And just like the income tax expense, any deferred tax expense equally is supposed to be credited in this account. How much is it? Is 15. And then from there, what we do, we balance our account, and we said the balancing figure in this account, which now is on this side, that is the tax paid. That is the tax which was paid. So let's compute now the tax which was paid as a balancing figure. What do we have on the credit side? 75 plus 110 plus what? 15, which will give us 200 minus what we have on the debit side, 14, 90, and 15. Yes, so we have a balancing figure here of what? Of 81. So this particular 81, this is the tax which was paid. And that's now what we need to capture here. The tax paid during the current year was how much? Was 81. So, and these two items, the tax paid and also the finance cost paid, those are cash outflows. And then finally now here what we do, we determine the cash flows from operating activities. From operating activities. Net cash flows from operating what? Activities. So how much amount will be that? So we have negative 168. What we have there? Minus 81 minus 18. So this will give us a 267. 267, which is basically a net cash outflows. Net what? Net cash outflows. So that's how we determine the net cash flows from what? From operating what? Activity. So having determined that, then we proceed, and now we determine the cash flow from what? The investing activities, and the cash flow from what? Financing activities. So let's start by determining the cash flows from investing activities. And basically this is quite simple because we have computed all the items which we need to take into account here. So what you have here to remember is that investing activities, these are activities involving what? The acquisition and disposal of asset. You take into account the asset which were acquired, the asset which were disposed, and any income from what? Investment. So I think from what we have in working one there was a disposal of plant, disposal of what? Of plant. And what we consider here, or what we take into account here, is what we refer as the sales proceeds. The sales proceeds. So this item was sold at how much? At 15 million, which is basically a cash inflow. Remember, you said any amount which is a cash outflow, we record it as a positive. Any amount which is a cash outflow, we record it as what? As a negative. Also, as far as the plant are concerned, we know there was acquisition. There was acquisition of what? Of a plant. The plant which were acquired had a cost of 60, which is a cash outflow. Record it as a negative. And then this will not has nothing to do with asset acquired or disposed. And then from this account for added building, we have these added buildings which were acquired. So there was acquisition of land and buildings at a cost of 110 million, which is still a cash what? A cash outflow. So I think that's what we have. Then the other item you should also always remember to include here is any income from investment. And in our question here, I hope you can remember we had this what? Interest receivable. So interest receivable, or in other terms, you can just refer to that as interest received. So in our case, we are not going to take into account this because this is the amount which was received during the current year, simply because if you go to where we have current liabilities, you'll be able to see we have interest receivable at the start and also at the end. At the current, not at the current liabilities, at the current asset, we have interest receivable at the start and also at the end. So how do we compute the actual interest which was received during the current year? We use the same approach I've explained here for computing the interest paid. So that means that we take the interest receivable at the start, which is 3 million. We add the interest for the year, which is 12, and then deduct the interest receivable at the end. So that will give you the actual amount of interest which was received during the current year. This 15 minus 5, which will give us 10. So that represent the interest, the actual interest which was received by the company during the current year. So, and I think those are the only items you're going to consider here. So what we need to do before we determine the cash flow from financing activities, so let's get the net amount. We have 15 minus 60 minus 110 plus 10. So this will give us a net cash outflow of what? Of 145. And then finally, we need to determine the cash flows from financing activities. From financing activities. And basically I've said that all the items which we include here, we get them from equity and non-current liabilities section of the statement of financial position. So can we go to where we have equity and non-current liabilities section? So we start with the equity section, and the first item there we have are ordinary shares. Ordinary shares at the start 200, at the end of the year 300. What causes the shares to increase? The issue of shares during the current financial year. So the company issued some ordinary shares during the current year, and they had a value of 100, which is now the increase. So the moment the company issues shares, the company receives money, so which is a cash inflow. Then below that we have share premium, which also increased from 0 to 60. So we have increase in share premium. The reason why share premium increases is because these shares which were issued at a premium, so which is still a cash inflow. And then below that we have revaluation reserve. Revaluation reserve, we don't consider it here because these are non-cash item. It basically these are reserve which changes because there were some assets which were revalued. The other item which we have below there is the retained earnings. Now this retained earnings is used in terms of computing the dividends which were paid. But if you can remember, in note number 6, we are given the dividends which were paid. We don't need to compute the dividends which were paid, but we just take into account the dividends paid as given in note number 5, which are 25. So basically dividends paid, these are cash outflow, recorded there as a negative. You can see all those items, we have gotten them from equity. So we then go to where we have non-current liabilities. Non-current liabilities, we have 12% loan notes, which at the start of the year were 150, at the end of the year were 0. So the reason why loan note reduces from a certain figure to 0 is because of redemption. And I hope you can remember in note number 4, there was a penalty which was incurred by the company here for redeeming this loan note early. So therefore here we can say there was a redemption of loan notes. So how much amount was paid on redemption? The amount which was paid on redemption is the principal amount, which is 150, and now to this we also include the penalty. Can you remember that penalty? Yes, you should go to note number 4. The penalty paid on early redemption was 6 million. So therefore the total amount paid by the company redeeming those particular loan notes was 156 million. Then we go back to where we have non-current liabilities, and we have 8% variable rate loan notes. And basically at the start of the year they were 0, at the end of the year they were 160. So these are loan notes which were issued. So we can say there was issue of 8% variable rate loan notes. And basically you can see the figure was, they increased by 160. So basically this is the amount which was received by the company by issuing other loan notes. So I think that's what we have. Deferred tax, we don't consider it here because we used that in terms of computing the tax which was paid. So therefore you can see all those particular figures there. We have gotten them from where we have equity and non-current liability. So what we need to do, can we get now the net cash flows from investing activities? We have 100 plus 60 minus 25 minus 156 plus 160. So that will give us 139, which is a positive. And then from there, next what we need to do is we determine something called the net changes. The net changes in cash and cash equivalent. So we determine that by adding 3 items: the net cash flow from operating, net cash flow from investing, and also what? Financing. So what do we have here? We have negative 267 minus 145 plus 139. So that will give us negative 273, negative 273. And then to this we add cash and cash equivalent at the start of the year. So in this case, when we talk about the cash here, we said we consider cash in hand, cash at bank, including bank overdraft and cash equivalent. These are short-term what? Investments. So what we do here, we go to where we have a current assets. We take into account the items of cash and cash equivalent. So at the current asset, which items of cash and cash equivalent do we have there? First of all, we have the bank balance, which was at the start, or 75. Equally, we have short-term deposit. Short-term deposit is part of cash equivalent, and I think we also given some information in respect to that in note number 5. So we have those 2 items, short-term deposit, then we have bank. Then it's also important for you to go to where we have what? We have the current liabilities. Check whether there was any overdraft. And we have an overdraft, but the overdraft at the start of the year was 0. So any overdraft, you don't add it because money which is owed to the bank, money which will have to be paid to the bank, you take it as a negative here, figure here. So this will give us a total of 195. 195, which is a positive what? Figure. And then what we do is to get now something called what? The cash and cash equivalent at the end. Cash and cash equivalent balance carried down, which is now at the end of the year. So we need to add these 2 figures here. What we have there plus this. So we have negative 273 plus 195. Okay, negative 273 plus 195. So this will give us negative 78, and actually this one should be the same with the cash and cash equivalent in the statement of financial position. So how do we get the cash and cash equivalent at the end of the year? We take the short-term deposit at the end of the year, 32, plus now the cash, the bank balance at the end of the year, 15, and then to this we less the bank OD, the bank overdraft, at the current liabilities. So whatever you get here, should be the same with that. And if that is the case, automatically we are correct. So we have 32 plus 15 minus 125. Yes, so that will give us, this will give us negative 78. And basically you can see that is the same with what we have there, Yes, so that is it, that what was required as far as that question is concerned. It was a question, an illustration question on the statement of cash flows, and basically that bring us now to the end of that particular topic. So what I need to do is maybe to give you an assignment. If you go to the past papers, specifically the paper for August 2022, financial reporting and analysis paper, and also the paper for December 2022, you'll be able to see there was a question on what? On cash flow. Make sure you attempt those 2 questions so that you can be able to understand this particular what? Topic. Otherwise, we come to an end of our class. See you in our next class.
Question 3. Question 3 reads, outline the priority of distribution of assets of a company after dissolution. Outline the priority of distribution of assets. A, priority of distribution of assets of a company after dissolution. Priority. Upon dissolution. To dissolve a company is to sell its assets. So when a company is dissolved, its assets are distributed in a certain order of priority. Okay? And this is in line with the Companies Act and insolvency laws. So tell me, candidates, who will be paid first after dissolving, after selling off the assets? What is the order of distribution of assets of a company after dissolution? Mercy says creditors. Bernard says payment to creditors. You see? Debenture holder. Ishmael says debenture holder. Moses says the liquidator. The liquidator. Bernard says payment of expenses incurred during dissolution. Company. Someone says company employees. DML says costs and expenses during dissolution. Preferential debts. So number one, you are saying preferential debts. Preferential debtors, debts, preferential creditors. Raquel says all expenses incurred in the winding up process. Creditors with fixed charge. DML, you have a point. You had gotten it first. Your first impression was accurate. You had mentioned secured creditors. Initially, DML, you wrote secured creditors. Secured creditors are paid first. What you are calling creditors with fixed charge. That's part of the secured creditors. These are creditors who have a security interest over specific company assets. Okay? Such as a bank. If a bank advanced a loan to the company and charged some of the assets, okay, then they have the first claim on the proceeds from the sale of those specific assets. If the company took a loan over the company's land and that land was charged, okay, it's a security or collateral for the loan, then the bank will have the first claim on the proceeds from that land. Okay? DML also mentioned preferential creditors. Preferential. Who are these preferential creditors? Now, this category includes certain debts that are given priority by law, even though they may not be secured. You understand? Examples include unpaid employee wages, e.g., unpaid employee wages. May not be secured, but they are given preference by law. We may have unpaid taxes. Unpaid taxes. These are taxes owed to the government. Then the third in priority is the unsecured creditors. Unsecured creditors. Unsecured creditors. And this is in most cases the largest group that includes all creditors who have a security interest or preferential status, like creditors, the normal creditors, we have the suppliers, we have unsecured loans, all that form part of this group of unsecured creditors. Then of course you have the shareholders. After all this, these are all creditors. Creditors, even unpaid wages, these are liabilities. Okay. Then after these external parties are paid, we move on to the shareholders. After paying external liabilities, then next in priority is the shareholders. If any assets remain after paying all the creditors, they are then distributed to the shareholders. You understand? After paying all the creditors, then we come to the shareholders. And when paying the shareholders, there is also priority. Preference shareholders are paid first before ordinary shareholders. Preference shareholders are given preference. Do you understand? Preference shareholders usually receive the capital back first. They receive their capital back first, and sometimes with unpaid dividends. If there are any outstanding dividends due to the preference shareholders, they are paid back their money plus the dividends, unpaid dividends. Then ordinary shareholders are paid last in line. They receive any remaining surplus. If anything remains, then it's given to the ordinary shareholders. Do you understand, candidates? So that's the priority of distribution of assets. Unsecured creditors, preference creditors, unsecured creditors, then the shareholders. Part B of the question reads, distinguish between private limited company, and public limited company. And dear candidates, I told you the other day, if you have to distinguish anything or things, distinguish between public limited company, private limited company, and public limited company. I advise you that you have two columns. You present the distinctions in columnar format. Public limited company, private limited company. Two columns. Then you have a basis for distinction or feature. That's the best way to present points if you are to distinguish or to give similarities. So this one is a very common question. So at least you have to give 4 distinctions to earn the 4 marks. The examiner needed to give at least 4 marks. So there are many distinctions. So do we give 8 or do we give 4? Somebody. Public limited companies can transfer their shares in stock exchange while private companies cannot. That is true. So companies are comprised of members or shareholders. So you can distinguish One, by the minimum number of shareholders. That's basis for distinction. Then you can distinguish by maximum number of shareholders. What is the minimum number of shareholders in a private limited company? Somebody. Minimum number of Okwera, that is correct. Minimum number of members required during incorporation. How many Okwera are required for private? How many for public? Banner says 2 private, 7 public. That is partly true. 1 private, 7 public. Maximum number of shareholders in a private limited company. Private companies are required to hold a minimum of 1 director, while public maximum. Private, that is true. 50. Maximum private 50. Public no limit. Then we can distinguish by 3, invite to public. Invite to public. Invite to public. Invite to public. Can private limited companies invite the public to subscribe for its shares or debentures? No. The DML says no. So private limited companies cannot invite the members of the public to subscribe to its debentures or shares. Cannot invite the public. Cannot invite the public. How about public limited companies? Can public limited companies invite? Yes. Can invite the public to subscribe to its shares. That's the third basis for distinction or feature. Someone has mentioned their transfer of shares. Are private limited company shares transferable? Are they transferable? No. They are restricted. Transferability of shares in private limited company is restricted by articles of association. These ones are easily transferable. So transferability of shares is another basis or feature which can help us distinguish the two. How about listing on stock exchange? Are private limited companies listed on the stock exchange? Are they listed on stock exchange? No. Not allowed. Not allowed. Allowed. Not allowed. Allowed. Listing. That's another basis for distinction. Listing. You can think of AGM. Is it mandatory for private limited companies to have annual general meetings? Because for public limited companies, it's mandatory. Okay? Annual general meeting. Not mandatory. This is mandatory. Annual general meetings are mandatory for public limited companies and not mandatory for private limited companies. How about company secretary? Are private limited companies required to have company secretaries? Company secretaries. Not mandatory. This one is mandatory. The law requires public limited companies to employ company secretaries. Okay? We can go on and mention things like minimum share capital. What is the minimum share capital? What about statutory audit? This one has come to mind. Statutory audit. It's not mandatory. This one is mandatory. You understand? Minimum share capital. What is the minimum share capital of private limited companies? Minimum issued share capital. So there are many features that can distinguish private limited companies from public limited companies. And these are 4 marks. So candidates, this is a simple question. And if there are many points, please, if you have time in the exam, give the points. You may think that the examiner will require, say, 4 distinctions. 1, 2, 3, 4. You may write up to this point when thinking that the examiner is giving a mark for each distinction, when indeed the examiner is giving half. So if there are many points and you have time, put down the points. Maybe because the examiner has not provided the number of distinctions. It's just written, distinguish between private limited company and public limited company. And there are many distinctions. We can write more than 10 distinctions here. It's only that time cannot allow. There are things like formation. It is simpler to form public limited company. It is complex to form public, complex public, simpler private. That's a distinction, formation process. So in the exam, I'm saying if you have time and the examiner has not stated the number of points you need to give, and there are many points, maybe is limited the number of marks. It could be half for you to earn the 4 marks. Do you understand? So if you have time, please, and you have the points, don't be too mean with your answers. Don't be too mean. You have 3 hours to answer this paper. So that is part B. Then part C says, with reference to incorporation of companies, explain the doctrine of adoption. Doctrine of incorporation. This is question 3, C Roman 1. Doctrine of adoption. Now, without referring to your notes, please make it real quick. What do you think? Doctrine of adoption. Doctrine of adoption. Mercy says, company on incorporation takes up pre-incorporation contracts entered under its name. Company on incorporation. I hope we all understand before incorporation, before the incorporation of a company, you may find that the company may have entered into contracts before it is incorporated. So Mercy says that the doctrine of incorporation refers to or means a company taking up pre-incorporation contracts. So it is the principle where a company, in other words, once incorporated, can choose to accept and take responsibility for contracts entered into on its behalf before its incorporation. That is to mean the company can adopt the way you can adopt a child that is not yours. Okay? Understand what I mean? You may have a spouse who maybe got a child before you got married. So you may decide to adopt that child who was born before your marriage. The same thing before a company is born. Because you know the birth of a company is the incorporation of a company. Before the company is born, there could have been other contracts that was entered into on behalf of the company that had not yet been born. So the company can choose to accept and take responsibility for contracts entered into on its behalf before its incorporation. May choose to. So Mercy, the wording there is may choose to. Okay? May choose to adopt. Or it may also not choose to adopt. It's not automatic. So, and that brings us to the second part of the question. Describe how the doctrine of adoption relates to pre-incorporation contracts. Describe how the doctrine of adoption relates to pre-incorporation contracts. How do you answer that one? Because candidates, we know that pre-incorporation contracts are agreements that are made by the promoters or the agents on behalf of a company that does not yet legally exist. And we know, candidates, such contracts are inherently problematic because a non-existing entity cannot enter into a binding agreement. So such contracts are problematic to that extent. So this doctrine of incorporation then provides a solution by allowing the newly formed company to, let me use the word ratify, to ratify the contract. So that is one point. Describe how the doctrine of adoption relates to pre-incorporation contract. So one way is that this doctrine allows the newly formed company to ratify the contract. I told you it's an interesting question. It's an interesting, you need to understand it. Explain how the doctrine of adoption relates to pre-incorporation contracts. How the doctrine of adoption relates to pre-incorporation contracts. I've just given one answer. This doctrine does what? Allows. The doctrine of incorporation provides a solution by allowing newly formed companies to ratify the contracts. Allows newly formed companies to ratify pre-incorporation contracts. That is one way in which the doctrine relates to these contracts. The company can formally adopt pre-occupation contracts. It can, if it wishes. It's not a must. Either expressly, it can ratify expressly. By expressly, I mean through board resolution, or it can be implied. And implied, I mean just by conduct, such as performing the contract's obligations. If the newly formed company proceeds and performs the obligations under the contracts that were formed before it was that were entered into before it was formed, if it carries out the obligations under that contract, then it is presumed that the company has ratified the pre-incorporation contracts. So that is one way. Another way is that it helps the company to assume liability. Assume liability. What do we mean by that? The company can formally adopt the incorporation contracts, that is through ratification. Then once adopted, the company becomes liable for contracts, terms, and obligations. Another way is through enforcement of rights. Enforce. It helps the company to enforce rights. The adoption of these contracts helps the company to enforce rights. The company also gains the rights to enforce the contracts against other parties, because the company cannot enforce the rights against other parties if it has not adopted the contracts that were formed before it were entered into before it was incorporated. So this adoption helps the company to do what? To enforce rights against other parties. So do you understand? So that is what was required there. That is how you explain the doctrine of adoption. Of course, there are other considerations we can say about adoption. As I mentioned earlier, there is no automatic adoption. Adoption is not automatic. What does that mean? That means that the company has the discretion to decide whether to adopt pre-incorporation contracts or not. Another consideration is that until adoption, the promoters or agents who entered into the contract on behalf of the company remain personally liable for its performance. And as we talk about adoption, it's important to mention what we call novation. 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 You may be required in your exam to define novation. In some cases, candidates the parties may agree to a novation. The parties may agree to a novation where the pre-incorporation contract is replaced with a new contract between the company and the other third parties, which then releases the promoters from liability. Because remember we said, until adoption, the promoters are held personally liable for the performance of the contract, but that they can be released through novation. You understand? So it's important for you just to understand that adoption, the doctrine of adoption, provides a practical mechanism for dealing with pre-incorporation contracts, which allows companies to benefit from agreements that were made on its behalf before it was incorporated, while also offering a degree of protection to the promoters who acted in the anticipation of the company's incorporation. That's it. Part C. Part D says, explain the following terms. Explain the following terms. Explain the following terms. And you see candidates in every question. Even if part B is difficult, you will score some marks in part D. Receivership. Give me the definition of receivership. Receivership. The next one is administration. Administration. Okay, the third word is liquidation. To liquidate. Any attempt? Definition of terms. These are just terms. I'm waiting for your answer. Receivership, candidates, we all know, is a legal process. Receivership is a legal process where a secured creditor does what? Appoints a receiver to take control of a company's assets that have been pledged as security for a loan. Do you understand, candidates? Ishmael says liquidation is a process of bringing a company into an end. I want you to get receivership first. It is a legal process where a secured creditor, you recall we talked about secured creditor in part A of the question, where a secured creditor, we talked about secured creditor here, where a secured creditor appoints a receiver. Because a secured creditor is one who has offered credit. It could be in terms of finances, and in most cases these are banks, could be a financial institutions. This secured creditor could be a financial institution or a bank. A bank appoints a receiver to help realize or sell or manage the secured assets on its behalf. So the secured creditor appoints a receiver to take control of a company's assets that have been pledged as security for a loan. And primarily, candidates, the objective is to realize the value of the secured assets, usually by selling, in order to repay the outstanding debt. That's the meaning of receivership. Ishmael attempted to define liquidation, but before liquidation we have administration. Administration. Now, administration candidates in Kenya refers to a formal insolvency procedure that is aimed at rescuing a financially distressed company. Administration is a formal insolvency procedure that is aimed at rescuing a financially distressed company. That is to say that administration provides a temporary shield from creditor actions, allowing a company a breathing space to reorganize its affairs and potentially avoid liquidation. That is the meaning of administration. Liquidation is derived from the word liquidate, which comes from the word liquid and is also known as winding up. It is the formal process of bringing a company's life to an end. And during liquidation, the company's assets are collected, they are sold, and the proceeds are distributed to the creditors according to specific order of priority, which we discussed in part A of this question. So liquidation is the process of bringing the life of a company to an end by selling all its assets and distributing the assets to the creditors in this priority. Secured creditors are paid first, preference shareholders creditors are paid next, and secured creditors are paid after preference creditors, then the shareholders. If anything remains, shareholders are paid. So any question? We've done 2 questions in today's lesson. April 2024 Company Law, question 2 and question 3. DML is asking, what is the difference between liquidation and dissolution? What is the difference? Now, DML, liquidation, I've just explained, is the legal process of winding up a company's affairs, okay? To liquidate is to wind up. That should be, first of all, taken note of. And dissolution, on the other hand, is an event. It is the final act of terminating a company's legal existence. It is the final act. And to distinguish the two, as I said, one basis for distinction between these two could be the purpose. You can look at it in terms of the purpose. The primary purpose, the primary goal of liquidation is to collect and sell the company assets, to pay the creditors in order of priority, and to distribute the remaining surplus to the shareholders. That's the purpose of liquidation. But on the other hand, the purpose of dissolution is to formally remove the company from the registrar of company's records. You understand? Thank you for attending the lesson. We will continue to revise even this easy paper that students do not find much trouble revising. It's good to just revise so that you can even get awards, because you should also aim at getting Kasneb awards. Bye-bye.
Welcome to Manifested publishers. We can be able to move on towards the right of the screen. I had initially mentioned we'd move down, but because we already have the formulas working down, we can be able to just move on towards the right here. We copy the pessimistic case, right over here, pessimistic case. Pessimistic case, and of course, because it's capitalized, so pessimistic. Like that. For consistency, just pick that. Format painter, you can see format painter. Also good for presentation. We copy the years 2020 to 2022, like that. Because we're talking about the focus period for the pessimistic case is going to be different from the base case. Copy. We can, right there, Control V. So we move towards the right, and one of the skills that you should also do or know is that we can be able to just hide this part here. Question is, will we be able to use all of this? We need them over here. So what I can do first of all, guys, before I hide, is to first of all pick these values over here. I'll just copy this, cut this, paste it right over here. Control V. So it moves towards the right. Now, if you allow me, I can pick right over here, up to that point, hide. How do you hide? You can, or you can be able to even group it. You can either right click and hide. You can see hide. It will hide. But we are accountants and we are experts like that. What we are saying is that we need to just put groups. So you come to data, then you group. Just click group. It will create this kind of thing. So you just click on this and it will just hide the data like that. If you want to unhide the data, you just click the plus. You open it up like that. That's what true accountants are actually supposed to do. So let's use the grouping outline. Now we come to pessimistic case. The reason for doing that is so that I can be able to look at the question and adjust them based on the inputs that, or these assumptions which have actually been provided right over here. So in a similar fashion, we forecast these values here, and we've already done that. So I ungroup this and allow me to pick these forecast values here like that. Copy. I press it back there. Control V. That. Now let's see how it actually changes the pessimistic case. We start all over again. I can put a white background home so that we can highlight as we make the changes. No fill, like that. Now we are doing the pessimistic case, guys, so please pay attention. Revenue growth rates are forecast under 3 scenarios, namely base case, optimistic case, and pessimistic case. The base case growth rate is the first year forecast in year 2022 CAGR. This is expected to reduce by 2% annually until the last year of the forecast, subject to a minimum of 15%. The optimistic case is 20% above the base case, while the pessimistic case is 10% below the base case in all forecast periods. So 10%. So what are you saying? 2022 CAGR over here. You can see in section, I can come down over here, 2022, the CAGR is down over here. You can see it right here. So we are saying what? We are saying that we are going to increase our revenue by, for the pessimistic case, is going to be 10% below the base case. So we are saying that even if the CAGR is increasing by 21%, the pessimistic case is going to be below by 10%. So we can come and say, right over here, the revenues like in the pessimistic case, so you can click right over here, you can see is 115. So we are increasing this from the previous value, this one multiplied by 1 plus the growth rate which was there in M21A over there. And then once we have that, it's going to reduce by, it's going to be reduced, yes, by 2%, but it's going to be 10%. So pessimistic case, what we can do, we can just pick plus this value times, open the brackets, so 10%, 1 minus 10%, close the brackets like that, and you enter. We are accountants, analysts, we need to highlight that, put a bracket for consistency. Then we are saying that that is for pessimistic case because it's 10% below. And if that's the case for 2023, like that, then you are saying it's going to reduce by 2%, like that. So even if we were to decide to go this other direction, guys, like that, if you're able to go like this, plus that value times, we go to question 21A, this one times 1 minus, we're saying 10%, 10%, it gives us 18, but perhaps the formula should be delete that. No, it's not giving us that value, correct value, so pardon me for that. Let me just undo that. We are saying that it should be able to go down by 20, so 21%, it should reduce by 10%. So we delete here. We are saying this 21% of ours should reduce by 10%. So plus that one times, open the brackets, 1 minus 10%. Then we close the brackets. Comes to 18.8%. Put percentage like that. This is pessimistic case, pessimistic. That 19%. Then what do we do after that? We come over to the second tab, tab 21B, you can see here, and we feed in the formula plus that sales, we multiply into brackets 1 plus this pessimistic rate over here, like that. Then we close the brackets like that and you press enter. So you can see it comes to 113. Because it is like the worst case scenario, we are saying compare that value or this 113 value over here, which you can put in a different color like that, with the one under the base case. Under the base case, you can see is 115 over here. So you put the same color like that. So you can see this is 115 base case, and this we're saying is pessimistic case or the worst case. It comes down like that. So I just undo like that, and then I proceed on. So once we have that, we come back now to what the question was actually saying. So the revenue growth rates, so the pessimistic case, optimistic case is 20% above the base case, while the pessimistic case is 10% below the base case in all forecast periods there. So we then reduce, this is expected to reduce by 2% annually until the last year of forecast subject to a minimum of 15%. So that is the limiting factor. That is the limiting factor over here. So plus this one times, open the brackets, we need the rates over here first of all, sorry. So we come back to 21A over here, 19. So we pick pessimistic case plus that value minus 2%. We get 16.87, but now we are saying we want it to be consistent like that. We want to reduce the percentages to be only with no decimal places, so it's 17%. Then plus that one times, we're reducing it by 2%. Remember what we did over here, minus 2%. So plus that one minus 2%, like that. We're saying we're getting 14.87. So because 14.87 is less than 15%, so we're saying the constraint is 15%. So this is 2023, 2024, 2025 should be 15%. So we're saying that now this is our 2023 value, 2024, 2025, and right over there. But 2025 should be 15%. Remember from the question, let me come to tab 21B right here. The question was saying subject to a minimum. You can see it over here. Subject to a minimum right over here of 15%. Subject to a minimum of 15%. So what does this mean? We're saying that we can come over to this other side over here as we try and populate this part. So we're saying it's plus that value times, shift, open the brackets, 1 plus for 2024. So we come back to 2024, we're saying it's 17%. That, we close the bracket, enter. Then these others will be 15%, 15%, 15% over here. So plus that value times, open the brackets, 1 plus 15%. 15%. That is the maximum, or the minimum we cannot go beyond that, beyond that value. We do the same, plus that one times, open the brackets, 1 plus 15%. We close the bracket, enter that. Then we can be able just to, even if we drag that, it will be able to pick like that. It's that value like that. So I was just doing it slowly so that we can be able to just see the values there. The cost of sales, we've been given the gross profit margin. What have we been told in the gross profit margin in the question? Right here you can see the gross profit margin. Let me just put it in beige, somewhat color like that. The gross profit margin for the first year forecast is the 3-year average for the period 2020 to 2022. So this is expected to reduce by 2% annually until the last year of forecast, subject to a minimum of 50%. So what is the gross profit margin? So I can come over here, move towards the right, and we reduce this base case scenario here. How did we do the gross profit margin? The gross profit margin is gross profit over sales. So the gross profit over sales, this one we had already done it like that based on 2020 values. So you can see, even if you're to pick this value over here, or we pick, let's say 2020, we can just decide to pick it over here, plus gross profit, which is over here, gross profit divided by sales, like that, 0.5. So for consistency's sake, we do the same right over here, 50%. And it applies all through until 2022. So we are saying that as far as gross profit margin is concerned, we are expected to apply these same rates that we have right above over here. So I can comfortably delete this one over here like that. I delete and say that now for me to be able to get the gross profit, I'll just get, you can see the gross profit right over here. You just multiply gross profit margin times the sales. So gross profit, so I get plus gross profit margin, 57%, multiplied by the sales. There, I get it like that, 64. So I drag the formula like that and it picks. So for us to get the cost of sales, we just get plus 113, but because it is minus, we open the brackets. You can see on the formula bar right over here. We just delete that, say is equals to minus that value minus that value there. We close the bracket, say enter. And we drag this towards, pardon me, undo. So plus or is equals to minus, open the brackets, 113 minus 64, close the brackets, enter 4, then we drag the formula until we get the plus sign like that. We drag the formula like that, then we put it in terms of the format, just put it like that. So we can try and check plus that plus the cost of sales, we're getting 64,381 to 2.29. So we can just, put it like that, and you can see we've gotten the correct answers like that. So we delete operating expenses. We go back to the question, right down here, highlight in peach. Operating expense ratio are modeled as the 3-year averages from period 2020 to 2022. These are assumed to remain constant over the forecast period. So what are we saying? We are saying that the expense ratio will also apply across. You can see the expense ratio just down here. So we pick, for us to be able to compute the operating expenses, because we've already done that in first part here. The operating expenses is just the sales times the expense ratio. So for us to get this, it is just plus the sales times the expense ratio. The expense ratio is right over here. Enter. But remember, it is negative. So we put a minus there and we open the brackets like that. Picks negative. And we just drag it, formula, like that, and it picks. Do the same thing as we've done above, format, that it picks the same format. How about operating profit? Let's see what the question is saying about operating profit. There's nothing about operating profit. It's a formula. So it's only operating expenses was there. So plus, it should be the same, plus that, you should get 42. Drag it like that. Let's see what they say about depreciation. Yes, there's something on depreciation. It's right there. Depreciation to revenue ratio is assumed to remain constant as the 3-year average for period 2020 to 2022. So we apply the same formula we've done just over here. You can see it right here. For us to be able to get the depreciation value, sales times depreciation ratio. So we come back towards the right over here, pick like that, time plus sales times depreciation ratio for 2023. Is that correct? Yes. Enter. And that's it. We drag it. That picks. But you can see clearly it's not the same format as this other one. So we do the same thing. Minus, open the brackets, close the brackets, enter. And then now we can redrag it again. Just drag it like that. It picks the negative sign, format, just do it like that, and that's it. Then we can just say profit before tax plus that. And of course, because this also requires the formula, you can see it will not change anything. But the format will change. So let's just undo that. We ensure that the format is the same as the previous income statement. So we just copy it like that, and that's it. What are they saying about finance costs? The finance costs down here, the finance costs are expected to reduce steadily as the loans are repaid. Use the reduction rate 2022 over the forecast. So you can see here reduction rate is 1,000 based on the base case, like that. Let's see how much it's reducing by in this case over here. It's reducing by still 1,000, 1,000, 1,000 like that. So how do we feel it? We just say plus this one plus that, so that we can be able to get 7,000. And we just apply it across. Format painter, do the same there. Profit before tax plus that plus this value. And we drag like that. How about the income tax expense? Let's move over to the right, to the left rather. Finance cost we've just done. Let's go to income tax. Is calculated as the historical effective tax rate. Put it as pitch, because we are saying it's just going to be plus that value times the 30% 2023 value there. That's it. Because it's negative, do the same thing. Negative, open the brackets, put it in brackets, like so. So we come over there and just drag it like that. We drag the formula as we move across like that, and then we get the final profit after tax. Plus that, enter. That's the final value that we have. So you can compare. You can see in the year 2023-7 forecast, we are getting 40,000 as the profit after tax in the pessimistic case. How about the base case? Let's remove this plus sign over here, the base case. We're getting 42,694 because it should be higher than this case over here, which you're saying is pessimistic case. So let's now put the format, we just put the paint, or rather the format, we try and format this whole part like that. And that's what we've done. That. So once we have that, we can then just move ahead to the base, to the optimistic case.
Welcome to Manifested Publishers.
Welcome learners to our today's session. My name is Celestine Wandabusi, and we are continuing with the revision management accounting December sitting. Today we'll be proceeding to question number 4 of the previous lesson. So question number 4, part A, we are told that outline 6 benefits that might accrue an organization as a result of preparing budgets. So 6 benefits for budget preparation, or which might accrue an organization as a result of preparing budgets. So number 1, I'll give a summary, then I'll explain. Number 1 is planning. We have a benefit, it is assisting in planning. 2, it will assist in controlling. Number 3, in coordination of activities. Number 4, can motivate. So we have motivation. Number 5, clarity of responsibility and authority. And then number 6, we have planning, we have controlling, we have communication as number 6. Communication tool. So 6 benefits for budget preparation. What are the benefits? When we prepare budgets, we do a financial or a monetary plan. And whenever we do a plan, it means that when we are spending or whatever activity we undertake according to that plan. And when we are doing that, it will help an organization, especially in allocation of scarce resources. Where there are no resources, an organization will be able to know where to allocate, when to allocate, so that is able to minimize costs to do with financing costs. And that is the work of planning. Like when we are preparing a cash budget, we normally look at what are the expected receipts, or what are the receipts and what are the payments. So when the payments exceeds the receipts, it means that we'll end up having a deficit budget. So when we have planned and we have a deficit budget, it will prepare an organization to know where it can be able to get funds to finance those activities or those expenditures that are yet to be financed. And then controlling is simply where we are looking at the actual results and that which was budgeted, so that we see whether there are any variances or discrepancies that will help an organization or the management to know the necessary actions to be undertaken. So through budgeting, we can be able to do the controlling function. How? We will look at our budget. What was that was budgeted? And what is the actual result? So when we have that which was budgeted and the actual result, we will be able to know the variances or the differences between that which was budgeted and that which is the actual. Like you had budgeted to spend 100,000, you have now spent 150,000. What is the difference? That is 50,000. Why 50,000? Is it favorable to an organization or not? And if it's not favorable, then which action should the firm undertake to ensure that that is not repeated again? That is, it is assisting in controlling function. And then coordination of activities. Through budgeting, all the activities of an organization can be coordinated. How? When we are preparing budgets, we do involve all the departments in an organization. And when we are involving all the budgets, we normally have budgets depending on others before they can be worked out. Like when we are preparing for Department A, sometimes when Department B is budgeting, sometimes it has to base on the activities of Department A before it finalizes on its activities. And through that, we will have coordination of activities relating one department to the other. Motivation, how can budgeting result to motivation of employees? When a budget is formulated, there are some targets that are normally set. When those targets are tight, they motivate the managers to work towards achieving them. And so, like when we have a plan of producing 100,000 units, the the manager who is responsible for the production department will have to ensure that he is able to produce 100,000 units. And so how does he do that? He is motivated to produce 100,000 because it is laid down in that budget for it to be met. And because of that, he will work towards achieving the 100,000 units, and that's what we are referring to as motivation. So where there are no budgets, managers will work the way they want. But if we have budgeting, it is motivating them because of the targets that have been set. Then number 5, clarity of responsibility and authority. In budgeting, we consider the high-level management involving themselves in budgeting. Though we have the mid-level managers and the lower level, but now when it comes to lower-level managers, they associate themselves with the workers or the subordinates. So to get all the information concerning what needs to be done, we have these supervisors or the lower-level managers who associate or relate with the subordinates so that they are able to report to the immediate supervisors who then will report to the highest level. And when such happens, we are able to clarify, or the organization can be able to clarify who is to do a DC, like during the budgeting process, and who should you report to. In other words, who is your senior. That is normally done during, like when we talk of the budget committee is outlining the management and the responsibilities of all those that are involved in the budgetary process. Number 6, communication tool. A budget can act as a communication tool, and therefore it has a benefit of acting as a communication tool. During the budgeting process, this budgeting process is involving communication. We have liaison of one department with the other, and that's done through communication. We have both vertical and horizontal communication, and therefore we say that a budget itself is communicating what needs to be done, and during the budgeting process, again, there is communication that is involved. And therefore, through budgeting, we can have a benefit of a budget being used as a communication tool. That was part A of question number 4. Then we move on to part B. We are told that you are in charge of making forecasts and preparing budgets for Condé Limited. You have been supplied with the following cost and revenue forecast and details of payment. So we have been given a forecast for revenue and cost for half year of 2022. So the details are beginning from January to June of the year 2022, and then we have additional information. Note number 1, cash balance, that is on 1st April 2022, is expected to be 90 million shillings. Note number 2, period of credit allowed by suppliers averages 2 months. Note number 3, debentures worth 125 million are expected to be issued in May 2022, and the amount will be received in the same month. Number 4, a new machine will be installed in March 2022 at a cost of 150 million, and payment is expected in the month of May 2022. Note number 5, sales commission of 3% is payable after 1 month of sale. And then note number 6, a dividend of 100 million is to be paid in June 2022. Note 7, there is a delay of 1 month in payment of overheads and wages. Note number 8, 20% of debtors pay cash, receiving a cash discount of 4%, and 70% of debtors pay within 1 month and receive 2.5% discount, while the remaining debtors pay within 2 months without a discount. Then required, a cash budget on a monthly basis for the months of April 2022 to June 2022. So when we prepare a cash budget, you need to understand what a cash budget is. So a cash budget is simply that budget that is recording the expected cash receipts and the expected cash payment. So we do not include any credit transaction on a cash budget. Where we have credit transactions, then the interest is when should this cash be received, or when should this cash be paid. So in the period when cash is received is when we record that on the cash budget, or a payment made is when we record on the cash budget. So we'll prepare the cash budget. So we have that format for preparation of a cash budget. So we are concerned with the month of April, May, and June. These are the periods for the budget. And so we will have details under that. So we'll begin to interpret the additional information. We are told that cash balance on 1st April 2022 is expected to be 90 million. So cash balance is simply that balance that is to be brought forward. So what we do, we bring it forward. This is cash balance that is brought forward. And it will be brought forward, we are told, cash balance on 1st April, which is expected to be, so that we'll record 90,000 instead of 90 million. So that is note number 1. Cash balance on 1st April is expected to be 90 million. So this is our cash that is to be brought forward. Then note number 2, we are told that period of credit allowed by suppliers averages 2 months. So remember, suppliers are those people who are giving this organization goods on credit. So that means they are the creditors to the firm. So they are allowing a period of 2 months. 2 months means, for example, if we have direct material purchases, we were given from January to June, and we are interested in preparing the budget for the month of April, May, and June. So when is this payment to be made? Giving an example, meaning when we have direct material purchases for the month of February, 2 months credit means those that were taken on credit in February are to be paid in April. So when we are preparing the cash budget, we will indicate that. Note number 3, we are told that debentures worth 125 million are expected to be issued in May. So our interest is when are they issued, not when they are issued, but when is the receipt of that payment. So the amount is to be received in the same month. So we'll record that. And then a new machine will be installed in March 2022 at a cost of 150 million, and the payment is expected in May 2022. So we simply record that amount based on that month, and then we will show the workings. Our number 1 working is note number 5, sales commission. Sales commission. We are told that sales commission of 3% is payable after 1 month. So that means if we are to calculate for the month of, so we want to calculate for the month of April, May, and June. So how will we calculate that? To calculate the sales commission for the month of April, we are looking at the sales for the month of March. What were the sales of the month of March? The commission for March is to be paid in April. And so for the cash budget, we will make payment in the month of April. So for April, we are taking 3% times the March sales, which were 440,000. For May, we will take the sales for April, which is now 3% of the sales of April, 350,000. What will we get? Then for June, we get the sales of May. That's 3% multiplied by 360,000. Then that will be the commission. So 3% of 440,000. This is 13,200. Then this will be 10,500. This is 10,800. So those are the amounts we'll use in the cash budget. We move on to note number 6. We are told that a dividend of 100 million is to be paid in June. So we will pay that in June. Note number 7, there is a delay of 1 month in the payment of overheads. Delay means there will be a lag in payment. So the payment that was to be done in the month of March will be done in the month of April. That were to be made in the month of April will be in May and so on. So there is a delay of 1 month in the payment of overheads. We've been given the overheads. So we have note number 2, overheads. Overheads. So the overheads here are including production. So what will we pay in April for production? In April, April, we have May, and we have June. So for production overheads, those that were to be made in March will be made in April. So in March we had 40,000, which is now to be made in April. So we simply write 40,000. For May, those that were to be made in April are the ones that will be made in May, which is 45,000. And then in June, those that were to be made in May are the ones that will be made in June, and that is 36,000. And then we also have administrative overheads. We have another 1 month lag. So those that were to be paid in March are to be made in April. So we have 27,000. And then for April of 24,000 will be made in May. And for May, 25,000 is to be paid in June. We also have selling and distribution. Selling and distribution, we also have 1 month lag. Those that were to be paid in March will be paid in April. That's 18,000. That which was to be paid in April will now be paid in May. That's 13,000. And that which was to be paid in May will be paid in June, which is 11,000. We were also told, and wages. We also have a delay of 1 month for paying wages. So the wages that were to be paid in March will now be paid in April. Those that were to be paid in April will be paid in May. Those that were to be paid in May will be paid in June. That's note number 7. Then the last note, number 8, we are told that 20% of debtors. So we calculate debtors, cash collections. So we have cash received. We are still using the month of April, May, and June. So what were the cash collections? We are told that 20% of the debtors pay cash. So we are to get 20% of the debtors in the month of April. So if we want to know how much was received in April, because it is received in cash, we calculate in April. So we have 20% for April times 350,000. 350,000. That will give us for April 20% of 350. That's 70,000. So for May, you are also getting 20% of May, which is now. So that is for April. The cash that was to be received in the month of April was 70,000. But on the same note, number 8, we are told that a cash discount of 4% was given. So when a cash discount is given, it is allowing or prompting the customers to pay promptly. And when they pay promptly, they pay less than what they should have paid if they were to pay at the end of the credit period. So that means when the firm is allowing that discount, it will receive less cash than what it will have received. And therefore, we are to subtract a discount. We have discount, we less discount at 4%. And discount at 4% simply means it will be 4% of 70,000. They were to pay 70,000, but because they are given a discount of 4%, they will not pay all the amount. And so what the firm receives is less than what they would have received. So 4% of 70,000 will be 2,800. So we subtract that, and whatever we get will be the cash received. So this is 67,200. So what we'll put to the cash budget will now be 67,200 and not 70. Why? Because there was a discount that was given to the debtors. We do the same for the month of May. So for the month of May, we are to calculate 20% of the May sales. 20% of the May sales. So the May sales were 360. 360, sorry. May sales were 360,000. So when you calculate that, this will give us 72,000, and then we are to less 4% of 72,000, which is 2,880. So we subtract this, and this will give us 69,120. This is the cash that is received. Then for the month of June, we also have 20% of the June sales, which were 360,000. So this will give us 72,000, and then we less 4% discount of the cash that was to be paid at the end of the credit period, which will be 2,880. So when you subtract this, we'll get 69,120. This will also be the cash to be received. Then on the same note, number 8, we are told that and 70% of debtors pay within 1 month. Paying within 1 month means when they buy in the month of April, before the end of April, they will have paid. So that means that amount is again to be recorded in that very month. So to calculate that, we also have now the cash collection at 70%. For the month of April, the sales were 350. So we get 70% of 350,000. And this will give us 245,000. We less a discount of 2.5% on 245,000. This will be so we less 6,125. Which will give us 238,875. Do the same for the month of May. Get 70% of the May sales, which were 360,000. This is 252,000. And then we less a discount of 2% on that which was to be paid. And this will give us 6,300. So when you subtract the cash, this is the cash collection. The cash collection will be equal to 245,700. And then for June, so the June sales equal the May sales. So we have 360,000, which will give us 252,000. Then we less 2.5% of 252,000, which will give us 6,300. So when we subtract, we will get 245,700. And then lastly, we are told in the same note number 8, we are told that while the remaining, so remember we had 20% of the debtors, we have 70%. So it means we still have a balance of 10%. So the remaining 10% pay within 2 months without a discount. So without a discount means we will calculate on the sales, and the 10% is what will be paid, but after 2 months. So since we were given sales from the month of January, it means that those that were to be paid in February will be based on the sales that were made in, those that will be paid in April will be based on the sales that were made in February. So cash collection at 10%. Cash collection at 10. This was at 70%. So the cash collection at this for the month of April will be equal to 10% of February sales. 10% of February sales, which is 350,000. So this will simply give us 35,000. Then May, it will be paid in 2 months. So meaning those that were given out in March are the ones to be received in May. So March sales, we get 10% of 440,000. And this will give us 44,000. Then June, those that are to be paid in June will now be calculated on the April sales. So we get 10% of 350,000. And again, this will give us 35,000. So once we make those adjustments, we now come to our budget and simply put in the figures. So once we have the cash balance that is brought down, we are to identify the receipts. We add receipts. So what are the receipts in the question? The receipts, we have the cash received. So we have cash from sales. For the month of April, what was the cash? We have 67,200. For the month of May, the cash received was 69,120. And for the month of June, we had 69,120. Then we have cash collection. Cash collections from debtors. So the cash collection from debtors for the month of April, we are taking this cash collection at 70% and the other cash collection of 35% or at 10%. So we have 238,875 plus at 10% 35,000, and this will give us 273,875. We do the same for the month of May. For May, the cash collection at 70% was 245,700, and at 10% for the month of May was plus 44,000. So this will give us 289,700. Then for the month of June, this was 245,700 plus 35,000. And this will give us 280,700. That is the cash receipts and collection from debtors. We also look into the question to find whether there were any cash receipts. In note number 3, we are told that debtors worth 125 million are expected to be issued in May 2022, and the amount will be received in the same month. So these debentures will be issued in May. So we have debentures. The cash received will be in May and the amount is 125 million. So you simply record in that period. There is no other cash receipt. So we underline this. So after showing the cash, we will calculate total cash received, which is simply the addition of this. So we show payments. So before I add, we'll show the payments. In the question, we had payments, we have commission. Commission was a payment. That is not number 1. So this is working number 1. This was overheads was number 2. Debtors was number 3. That's cash received number 3. Cash collections number 4. So cash from sales, this was working number 3. Cash collections, this is working number 4. And then commission, we have commission as part of payment. Sales commission. Sales commission. So sales commission for the month of, this is working number 2. Working number 1, not 2. For the month of April, we had 13,200. May, 10,500. And for the month of June, we have 10,800. Then the next cash payment is note number 2, that's overheads. So we have production overheads. This is working number 2. Production overheads, April was 40,000. May, 45,000. And June, 36,000. The next is administrative overheads. Overheads. Still working number 2. For April was 18,000. May, 13,000. And June, no. For April, administration should be 27,000. 27,000. For May, we have 24,000. And for June, we have 25,000. We move on to selling, distribution. Selling and distribution. Still working number 2. For the month of April, we have 18,000. May, we have 13,000. And June, we have 11,000. We also have wages. Still working number 2, wages. For April, we have 100,000. May, 72,000. And June, 54,000. So that was note number 7. Note number 5, we were told that, sorry, note number 5, note number 4, a new machine will be installed in March. So we have installation of new machine. We are told that a new machine will be installed in March 2022 at a cost of 150 million and payment is expected in May. So we make payment in May and that is 150 million. Note number 6, a dividend of 100 million. So we have dividend. Dividend of 100 million is to be paid in the month of June. So we will pay a dividend of 100 in the month of June. We were also told in note number 2 that period of credit allowed by suppliers averages 2 months. So the period of credit is applying to direct material purchases. When you look at direct material purchases, we were given from the month of January to June. So we are told that the period of credit allowed by suppliers averages 2 months. So we need to make credit purchases. Credit purchases. So the credit purchases are on direct materials. And so if given 2 months period, it means that that which was given in the month of February is what will be paid in the month of April. So for us to record the payment, we are recording the payment for the goods that were given in the month of February. So for April, we record that for the month of February. And for May, we record for the month of March, which is 135,000. And for June, we record for the month of April, which in that case is 90,000. So that's how we make payment. So for the month of April, we allowed the month of April and the month of March, so that the payment is made in the month of April. Then for those that were given in March, we are allowing 2 months credit so that it is paid in May and so on. So from there, we simply make the calculations. And when we are calculating, we begin with the first period, which in this case is April. So we'll get the receipts. So the total receipt is 431,075. We also show the total cash payments. So we will have total cash payment, and then cash balance that is to be carried down. So we do the cash payments for the month of April. So this is 298. Sorry, first. So this is 298, 200. So the cash balance is cash received minus cash payment. Which will give us 132,875. We do the same for the month of May. So this balance is now to be brought forward. This is 132,875. We bring it in the next period. So this will give us 616,695. This will be 449,500. So we get the cash balance to be carried forward, which will be 167,195. And then we bring it in the next period, 167,195. So the total cash here is 517,195. 015. So this will be 326,800. Then we get the balance to be carried forward. And this will be 190,215. So when we get a positive balance, that simply means it is a surplus. A surplus means the firm had more receipts or is expecting to receive more than what it will spend, and therefore there will be a surplus remaining, which can be used for other purposes of the firm. And that was all about question number 4. So you can read more on budgets and budget preparation. We have fixed and flexible budgets. You can look at other budgets, functional budgets like sales, production, labor, and fixed overhead, etc. And that brings us to the end of our session today. Bye-bye. Let's meet in the next session.
So let's move to part B of that question. Part B, the examiner was requiring the preparation of the statement of changes in equity. Statement of changes in equity for the year which ended 31st of December 2022. Now, remember, we say that this is prepared basically to show or to explain why there was a change in the various items of what? Of equity. In preparing this statement, we have said we start with the details column, and then we identify the items of equity our company had during that year. So items of equity include ordinary share capital and items of reserves. So if we go back to the trial balance, I think from where we have ordinary share capital, that is the first item, share premium, the second one, retained profit, that is the third one. Do we have any other like general reserve and revaluation reserve? No. So mean that in our case, we only have 3 items of equity, and then automatically we need to have what? We need to have the total what? The total column, the total column. So let's have those columns here. We have those columns here. I've said we have, we're going to have a number of columns. The first one will be the details column, details column, and then ordinary share capital, share premium, and then retained what? Retained profit, and then the total column, Also our figures here, we indicate they are in thousands of shillings. So what do we start with here? We always start with the opening balances. Balances brought down. So the balances brought down, these are the figures we have in the trial balance. For ordinary share capital, the opening balance was 200,000, share premium 50,000, retained profits 223, 640, 223, 640. Then what we need to do, basically we get now the totals. So we have 200,000 plus 50,000 plus 223, 223, 640, and that will give us a total of 473, 640. And then what we need to do is basically to take into account the transactions which occurred during the current year and which affected those items. The first adjustment which we need to make to this particular retained profit is what we were given in the additional information number 5. Not number 5, but note number 3, in relation to this particular budget, which was supposed to be written off which related to the prior year. So remember we said that this is a prior year adjustment. So therefore the first adjustment we make is to adjust this opening balance with the prior year adjustment. We say that the prior year adjustment, these are the adjustments which were supposed to be factored in, to be taken into account in the prior years, in the previous years, but they were not taken into account. Remember, this amount of bad debts was supposed to be written off in the previous year, but it was not written off. So what we do is that we deduct it from the opening retained profit, from the opening retained profit, and then from there we take into account the transactions which occurred during the current year. I think we can start by taking this right issue. This right issue. The right issue one, we said we need to add to the ordinary share capital, we add 40,000 because this amount was not accounted for, but it was credited in the suspense. And then to the share premium, we add what? We add 20. So that will give us a total of 60. We take it to the last what? To the last column. What else do we need to capture here? The profit for the year. The profit for the year here. The profit for the year. That will be added to the retained earnings at the start. And the profit for the is 371,490. And we take it to the last column there. Yes, that's what we have. What else do we need to capture here? In the trial balance, we have some interim dividends which were paid. So basically we know that dividends are paid from the profit, and therefore we need to list them here. So the interim dividends paid as per the trial balance were 10,000. So we list them here, and also we take that to the last column. Do we have anything else we need to capture? We need to take into account here from the trial balance. Okay, from the additional information, note 1, note 2, note 3, note 4, note 5, note 6, note 7. Yes, I don't think we have anything else. So what we need to do here is basically to get now the balances carried down, and we say that these are the balances now which we transfer to our statement of financial what? Position. So let's get those balances. The ordinary share capital here, the balance at the end will be how much? Will be 240. 240. What about the share premium? It will be 70,000. 70,000. What about the retained earnings? The retained earnings, the opening balance is 223, 640, minus 5,000, plus 371, 490, which is the profit for the current year, minus the interim dividend, which is 10,000. So that will give us what? It will give us 580, 130. And then we get now the total there. The total you can work out all that, or you add across. So let's just add across, and then we will confirm whether it is correct. So these we add 70,000. We add 240,000. 240,000. 240,000. 240,000. Yes, so this will give us what? This will give us 720. 720, 130. Maybe we can work this downward. We see whether that is the same figure we're going to have. 473, 640, minus 5,000, plus 60,000, plus 371, 490, minus 10,000, minus 10,000. Is that what you're going to get here? No. So let's I'm getting a figure here of 890, 130. So basically we can confirm again. So let's take 240,000 plus 70,000, 70,000, plus 580, 130, 130. Yes, the correct figure should be this one. So that is 890, 130, 130. Yes. So basically that is our statement of what? Changes in equity. Our statement of changes in what? In equity. And basically that what was required in part B. Remember this is part B, not part A. Part B. So then finally, we prepare now the statement of financial position. Statement of financial position. Position as at 31st of December 2022. 31st of December 31st of December 2022. So this is quite simple because we have most of the items to be included here. For example, we have all the items of what? Items of equity. So when preparing the statement of financial position here, we said we start with the assets. First of all, we record the non-current asset and then current what? Asset. So what we start with are the non-current assets. The non-current assets, we need to have a single column here, and also we have to indicate that all our figures are in thousand of shillings. All our figures are in thousand of what? Of shillings. So these are non-current what? Assets. Non-current assets. So what we start with here, definitely we're going to start with the PP, the property, plant and what? Equipment. And in our case here we have various items of PP. We have property, we have plant, we have motor vehicle, we have office what? Equipment. So what we need to do as far as those items of PP are concerned is we compute their total net book value at the end of what? Of the year. And basically we include that here as a single figure of what? The PP. Remember what you have said here is that when preparing a statement of financial position for publication purpose, you don't record those items here separately. For example, you compute the net book value of plant, we include it here separately, plant the same. No, we don't do that. In fact, in an exam situation, if you do that, those items will not be marked for you. So what you do as far as the tangible and current asset are concerned, you compute their total net book value, all of them, and then you include that here as PP. As what? PP. So let's start with the property. Property, the cost is 60. And because this property include building, we have now to less the accumulated depreciation of buildings at the start of the year. Basically, we have to less the accumulated depreciation for buildings at the end. So what would be the accumulated depreciation for buildings at the end of the year? Accumulated depreciation at the end of the year. So in terms of how we compute this, we take the accumulated depreciation at the start, which is part of the trial balance, or which is in the trial balance, and then we add the depreciation for the current year. The depreciation for the current year for buildings is how much? Is 10. So this will give us a total of 90. So we let's start now from the cost. From the cost. Then to this, we add plant. Plant, that is, the cost is 2 what? Is 280. And then what will be the accumulated depreciation of plant at the end of the year? We take the accumulated depreciation of plant at the start as given in the trial balance, 111, 160, and then we add the depreciation for the year here. How much is it? 14.5. 14.5. So this will give us an accumulated depreciation of what? It will give us accumulated depreciation of 125, 560. So let's just confirm that. We confirm whether that is correct. That addition is correct. We have 111, 160 plus 14, 500. So which will give us a total of 125, 560. Yes. So we less it here. 125, 560. But also, as far as the plant are concerned, we have to remember something. There was a plant which was disposed, and that plant is part of this. So what we need to do, the plant which was disposed, we need to less it from this net book value which you are going to get. Can you remember the net book value of this plant which was disposed? I think we can compute its net book value. Its net book value will be 39,700, and then minus accumulated depreciation. It's accumulated depreciation of 15, 860. So therefore, its net book value was 23,840. So what we have deducted here is the plant which was disposed because it was not accounted for. So then from there, we add the net book value of motor vehicles. So what will be the net book value of the motor vehicles? We take the cost, which is 70, and then equally we compute the net book value at the end. The net book value at the end will be equal to the the accumulated depreciation at the end will be equal to the accumulated depreciation at the start, 42, and then to this we add the depreciation for the current year. How much is it? 14,000. 14,000. So that will give us a total of 56,000. So we less it from the cost, which is coming to 56,000. We less it from the cost, and finally we add office equipment. Office equipment, the cost is 40, and then we compute the accumulated depreciation at the end for office equipment. The accumulated depreciation at the start, as given in the trial balance, is 15. What about the depreciation for the year? 5. So the accumulated depreciation at the end for office equipment is 20,000. So we less that now from what? From the cost of 20,000. Yes, so that basically how we compute what? The net book value for the property, plant and equipment. Remember, property, plant and equipment here, these include all tangible and current assets. So let's work out that. We have 600,000 minus 90,000 plus 280,000 minus 125, 560, minus 23, 840. This is the plant which was disposed, plus 70,000 minus 56,000 plus 40,000 minus 20,000 minus 20,000 minus 20 what? 1,000 minus 20,000. So I think we can confirm that working so that we get the correct figure. Let's confirm that. So the first figure is 600,000. 600,000 minus 90, that is okay. And then plus 280,000 minus 125, 560. 125, 560 minus 23, 840. Plus 70,000 minus 56,000 plus 40 minus what? Minus 20, yes. So I'm getting a final figure here of 674, 600, yes. So that is the final figure for the PP. And then here we said we check for other assets like intangible asset, the investment, and so on. So let's go back to the information which we have in the trial balance. I think in the trial balance we have already captured the first items of PP: property, plant, motor vehicle, office equipment. Below that we have accumulated depreciations. And then we have opening inventory, purchases, distribution, admin, revenue. We have already captured all those particular items here. Trade receivables, trade payables, those are items of current asset and current liabilities respectively. And then that bank balance, you can see that is an overdraft because the balance is on the credit side, is still a current liability. Deferred tax, that is an item of non-current liability. Current tax, we have already captured that. Bank interest, we have taken into account that. And then ordinary share capital, share premium, retained profit, all those are items of equity. Interim dividends and suspense, I think we have already captured all those. So basically it means that we don't have any other item of what? A non-current asset. So what we need to do is we proceed and record now the items of current assets. So let's record current assets. Current what? Assets. So for current asset, we have a number of items. In the trial balance, we have trade receivables. Now the trade receivables, in the trial balance is given as a figure of 74,500. But this figure will need to be adjusted with this particular amount of 12 million, which was included as part of the receivables, but you're told those receivables are non-existent. So we reduce our receivables with an amount of what? 12. So we deduct 12 here, which will give us 62,500. Okay. And then from there we check whether we have any other item of current assets. So the bank balance which you're given in the trial balance, you need to know that that is a bank overdraft because it is on the credit side. The examiner will not tell you that. It is upon you to know that that is a bank overdraft and therefore is a current liability. Yes. In the trial balance, we don't have any item of current asset. What about the additional information? Number 1, you have dealt with that. Number 2, 3, 4. In note 5, we have the crossing inventory. The crossing inventory is included here as part of a current what? A current asset, which is 85. And then I think we are through. Yes, we don't have any other item. So what we need to do now is to get the total assets. To get the total what? The total assets. So let's add these particular items and PPE, and then the 2 items of what? The 2 items of current liabilities. So we have 674,600 plus 62,500, 62,500 plus 85,000 plus 85,000. So that will give us total asset of 822,100. 822,100. And then from there, we proceed and record what? Equity. Now for equity, this is quite simple because we have all the items of equity to be included here. From where? From our statement of changes in equity. So we just need to copy paste those items here. We start with ordinary share capital. Ordinary share capital, the balance at the end of the year was 240,000. We have share premium. Share premium. The balance at the end of the year for share premium is what? 70,000. 70,000. Then we have the retained profits. The retained profits. At the end of the year, it was 580, 130. And now what will be our total equity is what we have here. Total equity. Total equity. Total equity is what? Is 890. Is 890, 130. 890, 130. Okay. So then from there we proceed and we record the non-current liabilities. The non-current liabilities. Non-current liabilities. So which non-current liabilities do we have here? So for non-current liabilities, we say these include things like the bank loan, things like debentures, redeemable preference shares, and maybe something like the deferred tax. So what we need to check are the non-current liabilities which we have here. And in this question, we don't have bank loan, we don't have debentures, we don't have redeemable preference shares. I think in our case, we will only have one non-current liability, and that is the deferred tax. And the deferred tax which we include here, first of all, if we go back to the trial balance, we are given a deferred tax of 32,400. But remember what we are told in note number 4, that the deferred tax provision is to be reduced with how much? With 3 million. So therefore, the amount of deferred tax to be recorded here, the amount of deferred tax which will be recorded here as a liability, we take the amount given in the trial balance, which is 32,400, and then we reduce this with how much? We reduce that with 3 million. So this will give us what? This will give us 29,400. 29,400, and equally we can confirm whether that is working is correct. 32,400 minus 3,000. Yes, that will give us 29,400. So do we have any other non-current liability? I don't think so. We don't have any other non-current what? Liability. So finally what we need to record are the current liabilities. Current liabilities from the trial balance. We have what? Remember the liabilities have a credit balance. So check the items on the credit side. So one, we have the trade payables. The trade payables. The trade payables is an amount of 68,800. Then below that we have the bank balance, or basically the bank overdraft. The bank overdraft, and the bank overdraft is 15,500. 15,500. Yes, I think those are the two items which we have in the trial balance here. In the trial balance, and then in the additional information we check whether we have any other item of current liability. Note 1, we don't have any item of current liability. Note 2 is about depreciation. Note 3, and then note 4, we have the current tax for the current year. The current tax. So that tax, remember, had not been paid, and you are told in this case the company was supposed to pay, or the estimated tax liability for the current year was how much? Was 52. That's what we include here. Yes, and then note number 4 is about note 5 is about inventory. Note 6 is about what? About now the right issue, the amount of what? The right issue. So I don't think we have any other item of current liability to be included here. So what we need to do here is to get the total equity and liabilities, the total equity and liabilities. But there is something we need to adjust here. There is something which we added longly, because if you take on what we got here as the total equity, definitely you'll be able to see that that is more than total asset, which is basically long. So the figure which is wrong is this figure for retained earnings, or basically the retained profit. So there is something we added longly here. We need to make some changes quickly. So what do we have here? We have 138,000 plus 667,000 minus 85,000 plus 3840 plus 14,500. So that will give us what? That will give us 738. So this figure, instead of adding what we did, we deducted, which was actually long. So the correct figure here should be 738. 738 what? 340. So then we get the correct figure for the gross profit here. That was an error. So let's get the correct figure for the gross profit. We deduct that from our revenue, 1103,500, and that will give us now the correct figure for the gross profit here to be 365, 160. So what else do we need to change? Our profit here before tax. Our profit before tax. So our profit before tax, we take 365, 160 minus now the three expenses, 58,000 minus 115, 500 minus 2,400. So that will give us a figure of what? 189 to what? 260. And then we less the current tax, which is 54,600 plus the deferred tax income of 3,000. Yes, and our correct figure here for the profit for the year would be 137,660. Equally, that will be the total comprehensive income there. Yes, so that was basically a small addition, a mistake or error. So we also need to adjust this figure for the profit for the year, because the correct profit for the year is how much? is 137, 660, 137, 6 what? 60. So meaning that these will also change here. This will also change here. Those two figures will change. So let's work out this. The retained profit at the end of the year. So we take the opening balance here, 223, 640, minus 5,000, which was the prior year adjustment, plus the profit for the year 137, 660, minus the interim dividends which were paid of how much? 10,000. 10,000. So that will give us a figure of 346, 300. Yes, and then we get now the total equity there. So we can work out that we take 346, 300 plus the 70,000 which we have here, plus 240,000. 240,000. So that will give us now the correct figure here of 656, 300. So therefore here we equally need to change this figure here. The retained earnings at the end, the correct figure is what? 346, 300. And the total equity as per our statement of changes in equity is 656, 3 what? 300. I think now we can get now our total equity and what? Liabilities. So our total equity is 656, 300, plus now the deferred tax 29, 400, plus the payable 68, 800, 68, 800. I hope that figure is correct. Yes. Plus the bank overdraft, which is 15, 500, plus the current tax 52,000, 52,000, 52,000, 52,000. So let's take that again. We start from equity there, 656, 300, plus 29, 400, plus 68, 800, plus 15, 500, plus 52,000. 52,000. Yes, that will give us what? That will give us a figure of what? A figure of 822, 100. 822, 100. 822, 100. Yes, yes, yes. So basically that is it. That what was required as far as that question is concerned. That was an illustration question on the topic of what? A published financial statement. So basically that brings us to the end of that particular class. We meet in our next class as now we look on how we prepare the statement of cash flows. Remember what so far we have covered here is the preparation of the statement of comprehensive income, statement of changes in equity, statement of financial position, and then what is remaining is for us to discuss something to do with the statement of cash flows, the presentation of the same, and so on. So see you in the next class as we look on that.
August 2023, Leadership and Management. Question 1. Paragraph 1. Marina Company Limited MCL is a multinational company whose headquarters are in New Delhi, India. The company established its offices in Kenya in the year 2012 and currently operates in 15 other countries across the globe. The company specializes in solar technology and offers alternative power solutions in remote areas where main electricity power cannot be accessed easily. The vision of MCL is to power the world and bring comfort to the forgotten. Paragraph 2. The company manufactures most of the appliances centrally in India and then ships them direct to its global markets. At the initial stages of establishment, MCL collaborated with technical institutes to train technologists who assembled and maintained the appliances. The company's after-sales services approach has boosted its customer base globally. Any major repair was referred back to New Delhi. In the year 2013, MCL hired a business analyst to carry out a worldwide business analysis with the aim of identifying countries where new offices could be set up. This decision would be based on a wide variety of factors. Globally, MCL customers were classified according to geographical regions. Africa region was the largest, with MCL present in 5 countries. The company had enjoyed monopoly status in the countries where it operated for a long period of time. From the year 2018, competition has been building up, where some companies have been able to offer more advanced and better products. This has led to MCL's bottom line being impacted adversely. The competitors' products are imported as complete portable sets and do not require local assembly. The marketing model used by competitors borrows heavily on multi-level marketing and therefore embraced by MCL customers. Perception associated with companies such as ML, which sell large quantities, undermines quality selling. The competitors introduce new modes of selling, including hire purchase and loaning for the appliances. These modes were quickly adopted by customers. Peter Quick joined MCL in the year 2020 as the head of sales Africa region. At the time, competition was very stiff and the financial position of the company was very low. Major customers that had remained loyal to MCL were shifting their loyalty. By the year 2021, the competition grew exponentially as new entrants joined in with cheaper and more technologically advanced appliances. Kan Ho, the Global Operations General Manager, whose office is in New Delhi, planned for a brainstorming workshop in the year 2022 for all regional sales heads to advise on the way forward. The regional sales managers were required to provide scientific responses to the problem, guided by facts and the unique challenges in each of their regions. Kan Ho expected that the workshop would yield remedies to the effects of fierce competition and the way forward would be arrived at. In preparation for the workshop, Peter Quick and his team carried out an in-depth internal and external analysis of MCL, studied the competitors' strength, customers' behavior, market volatility, competitors and products differentiation. In the analysis, it was indisputable that some of MCL products were unique and effective in the market. To enable him understand the reasons behind the customer shift in loyalty, Peter Quick purchased some of the competitors' products and shipped them to company's main laboratories in India for detailed analysis of their constituent parts. The laboratory report revealed that 70% of the competitors' products comprised of MCL's products components. The only major differentiating factor was the logo, color, and packaging. Most of the competitors were buying MCL's products, adding on a few improvements, the branding, packaging, and selling the products in the market as their own. In his presentation, Peter Quick noted that the assignment was complex and weighty. To enable him have a logical presentation during the workshop, he classified his findings in the following categories: marketing strategies, production and operations, human resource, ethics and morals, and legal issues. The workshop recommended certain measures to be undertaken. These measures included: 1. To broaden the customer base. 2. Top management to implement e-marketing strategy. 3. The company to reclassify their customers according to products. 4. MCL to reduce cost of their products. 5. Litigation and court action against companies that had used MCL's patent illegally. By the beginning of this year, the company's bottom line has started showing a positive increase. Customers were trickling back in, and it is expected that by the end of the year, the company will have regained its lost market share. Required Roman 1. Discuss 3 possible reasons why MCL engaged in the services of a business analyst. That is the question. I must give you an opportunity to retrieve, to recall. We've just read the case, and I think I gave you enough time to go through it so that you can understand the dynamics within the case study. What are the possible reasons why this company engaged the services of a business analyst? Patricia says, looking for new markets. Patricia, we can use the term identify other than looking. Identify new market opportunities. You can rephrase it to identify. Identify, that's a good point. New market, that's a strong point. The business analyst may have been engaged to help this company to identify new markets. And it's written there in paragraph 3, candidates. In the year 2013, MCL hired a business analyst to do what? To carry out a worldwide business analysis with the aim of identifying countries where new offices would be set up. Okay, so that is the reason. It's just within the question. The business analyst could assess the potential markets for expansion. This analyst could also consider factors such as market size, the growth potential, regulatory requirement, and other competitive landscape, and that could help the company make informed decisions about as to whether to establish new markets and then allocate resources in those markets. That is one reason. Pick directly from the question. But the question is, what are the 3 possible reasons? Patricia says to help in meeting competition. In meeting competition. So there has to be a point on competition. To assess reasons for shift in customer loyalty. Assess reasons. Is it assess? Which is the right verb? It's not to assess. What did you say? To know reason for shift. Which is the right verb? As you are thinking of the right verb there, Patricia says to help in meeting competition. In meeting, other than meeting, before you address the issue of competition, Patricia, the business analyst may have been sought to first of all assess you can say to assess the competitive landscape. To assess, say, market trends and competitive market. The competitive, not market, but landscape. Competitive landscape. To assess before finding solutions. You cannot find solutions before you get the reason. So the business analyst may have been engaged to assess the market trends, and then based on that assessment, we can do what you are calling meeting competition, right? So the business analyst could track market trends, including emerging technologies. It could also assess competitor strategies in the solar industry. Yeah, in the solar technology. It is the solar technology industry. Okay, it could assess competitor strategies in the solar technology industry, and then that could help the company to maybe stay ahead of the curve. It would help the company to anticipate changes in customer preferences and adapt the products and services accordingly. So, assessing market trends and competitive landscape could be the reason why this business analyst was engaged based on the information given. All right. Then another reason could be someone else. Why are you not thinking about efficiency? Operational efficiency. Business analysts can help a company to evaluate its operational efficiency. To evaluate the company's operational efficiency. The business analyst can analyze the current operations, including production processes, distribution processes, customer service processes, so that bottlenecks could be identified, inefficiencies could be identified, and any areas for improvement. And when such areas are improved, then it can lead to cost reduction. It could also enhance performance. So that is one reason why a business analyst may be engaged in any company apart from this one, especially a company that is facing tight, stiff competition. You can have a business analyst to come and help evaluate operational efficiency so that the processes are evaluated. The purpose for evaluating processes and identify examples like the production, distribution, customer service, so that the company can identify areas for improvement or if there are any bottlenecks. You understand? Yes. So these are 3 reasons. Then part B of the question reads, evaluate 4 internal factors that would have played part in impacting on MCL's bottom line. Internal factors. What do you think? Now, candidates, bottom line literally means or refers to a company's net income or profit. Understand? Patricia says MCL produce inferior products. Where are you getting that point, Patricia? Which paragraph? Paragraph 4. Paragraph 4, I read, from the year 2018, competition has been building up where some companies have been able to offer more advanced and better products. More advanced and better. That means they are superior compared to MCL's products. This has led to MCL's bottom line being impacted adversely. You see what Patricia has done? She's just picked an answer from the question, which has led MCL's bottom line, okay, which has led to MCL's bottom line being impacted adversely. All right. So that is true, Patricia. One reason, inferior products. Because we read that competition has been building up, where some companies have been able to offer more advanced and better products. That means MCL's products are inferior to these better products. So that has led to, and we read this has led to MCL's bottom line being impacted adversely. That is true. Any other point? Competitors' use of multi-level marketing led to decline in MCL's market share. Which paragraph is that, Kidiga? So the competition led to decline in market share, which then led to decline in the bottom line. Decline in market share means that the customers have reduced. And one way to reduce the bottom line is to reduce the market share. So that is true. So candidates, you can see these questions, there are no specific answers. The way you put it, like Patricia told us, inferior products. The reason why this company has inferior products is because there is stagnation in innovation. Product innovation stagnation. It's the same thing. Product innovation stagnation. Competitors are improving the products. MCL has stagnated. Their products are, in other words, inferior. So a student will say product innovation stagnation, that's a point. The one who says inferior products, that's a point. That's why I'm giving you an opportunity to tell us the answers, which I know will be correct. Kidiga has told us competitors' use of multi-level marketing. That is a point. That is to say, in other words, Kidiga, that MCL has been using ineffective marketing strategies. Ineffective marketing strategies. MCL's marketing strategies are not as effective as the competitors' multi-level marketing strategy. We can say that MCL's traditional marketing approach might not be as effective in countering the multi-level marketing approach. You understand? Might not be effective. And we even read that the competitors were giving loan options, higher purchase to customers to buy their products. So the competitors, in other words, were adapting to changes in customer preferences. And these are just marketing tactics that could that led to loss of market share. You understand? Keep going. These are your points. These are your points. They are not my points. I'll help you refine them. Give me another point, please. Someone has dropped a point. R says MCL local assembly could be adding more costs, unlike competitors who import complete portable set. Now, how do you put it in 3 words, that point, before you give that explanation? How do you summarize that point in 2 or 3 words? Because it is a point related to assembling. And I think we read that MCL production is in India. The products are assembled in New Delhi and then they are shipped to global markets. Okay? You understand? Which impacted the bottom line because of increased costs, because of delays. Okay, that led to delays, led to increased costs, and also challenges. Unlike competitors who offered complete portable sets. Do you understand? So to just put it in a few words, we can say centralized production and assembly. Centralized production. Centralized production and assembly. This impacted the MCL's bottom line. You understand? Any other point? We are discussing internal factors that played a part in impacting MCL's bottom line. What can you say in relation to the expertise? We read that MCL initially did what? Initially relied on collaboration with technical institutes for local assembly and maintenance. Do you understand? Initially. Which paragraph is that? Paragraph 2. The company manufactures most of the appliances centrally in India and then ships them directly to its global markets. At the initial stage of establishment, MCL collaborated with the technical institutes to train technologists who assembled and maintained the appliances. So that was what happened initially. So MCL initially relied on collaboration with the technical institutes or for local assembly and maintenance. And as competitors emerged with more advanced products, MCS local teams might not have had the expertise to compete effectively in terms of product knowledge, in terms of after-sale services, or even technical support. So there could have been lack of local expertise. Lack of local expertise could have impacted the bottom line. So those are 4 internal factors. Part C of the question reads, examine 4 ways in which MCL could apply Michael Porter's generic competitive strategy to regain its competitive advantage. I'll turn to you, Betty. Betty says differentiation. Hidiger says cost leadership. That is correct. Differentiation. 1, differentiation. 2, someone has said cost leadership. That is a point. Cost leadership. Keep going. What else do you know about these generic strategies apart from cost leadership and differentiation. The question is specific. Michael Porter's generic competitive strategies. One, you identified cost leadership. Patricia says lower cost. Patricia, lower cost is the same as cost leadership. Kidiga says, how about more market focus? Yes, that's the point. Focus. That is the point. Put it down. Number 3, focus. These are the 3 main strategies according to Michael Porter. Michael Porter identified 3 primary generic strategies: differentiation, cost leadership, focus. Okay? Primary. Those are primary strategies. But the question requires us to give 4 ways. One way is cost leadership. What's the meaning of cost leadership? What could MCL do in relation to cost leadership? Now, MCL could focus on reducing production costs. It could focus on streamlining operations and even obtaining or optimizing, let me say optimizing its supply chain to offer products at a lower cost, lower prices, which will then lower the prices. Do you understand? Cost leadership means producing products at the lowest cost compared to competition. Because these are competitors, they are producing the same products. One strategy to gain competitive advantage is to produce those products as the lowest cost. Because that would then attract price-sensitive customers and regain market share. Because if you are offering products at a lower cost, then you can reduce your prices, the prices that you are selling prices. You understand? So that's a strategy, according to Michael Porter's generic competitive strategies. That is the first one, cost leadership. Because there are customers who are sensitive to prices. Price-sensitive customers can be attracted when the selling prices are reduced. Then we have another strategy, which is differentiation. Now, differentiation focuses on making a product or service unique and desirable to customers. And we know companies can differentiate themselves through superior quality, through innovative features, through strong branding, through exceptional customer service, and so on. Differentiating. And therefore, MCL could invest in research and development to create unique, innovative products that stands out from the competition, from the competitors. And that could involve developing, say, new solar technologies. That could involve enhancing product features. That could involve offering superior after-sale services, and so on. That is differentiation, to differentiate your product from that of the competition. Then the fourth strategy is focus. Now, focus is the third primary generic strategy, which involves concentrating on a narrow segment of the market, to focus on a narrow segment of the market, that can be either through differentiation or even cost leadership. You understand? Companies with the cost focus target specific market niche and aim to be the lowest cost producer within that niche. And companies with the differentiation focus target a niche market and offer unique products or services tailored to that specific segment. So focus can either be in relation to differentiation or cost leadership. So this company could combine elements, or even before combining elements, this company could rely on focus strategy by targeting specific market segments or even specific geographical locations where they have a strong understanding of customer needs and gain competitive advantage. So that would enable the company to tailor their products and services to those specific niches, and that could build stronger customer loyalty and then differentiate themselves from the broader competitors. Focus is a generic competitive strategy. So these are three, but the question requires candidates to provide 5 ways. So these are the primary ways, but there is also a hybrid strategy. Hybrid. Okay? Hybrid strategy, number 4. Hybrid strategy. This is cost leadership strategy, focus strategy, differentiation strategy. Then there is that hybrid. Hybrid candidates is just a combination of elements of differentiation and cost leadership. For example, this company could offer a range of products with varying features. Okay? A hybrid combines the two, cost leadership and differentiation. So such a strategy could help them to capture a wider market share while maintaining profitability. So those are 4 ways in which MCL could apply Michael Porter's generic competitive strategies. Always remember, candidates, there are 3 primary strategies: cost leadership, differentiation, focus strategy. Then there is the one we are calling hybrid that combines the elements of cost leadership and differentiation. Paragraph 1. Marina Company Limited MCL is a multinational company whose headquarters are in New Delhi, India. The company established its offices in Kenya in the year 2012 and currently operates in 15 other countries across the globe. The company specializes in solar technology and offers alternative power solutions in remote areas where main electricity power cannot be accessed easily. The vision of MCL is to power the world and bring comfort to the forgotten. Paragraph 2. The company manufactures most of the appliances centrally in India and then ships them direct to its global markets. At the initial stages of establishment, MCL collaborated with technical institutes to train technologists who assembled and maintained the appliances. The company's after-sales services approach has boosted its customer base globally. Any major repair was referred back to New Delhi. In the year 2013, MCL hired a business analyst to carry out a worldwide business analysis with the aim of identifying countries where new offices could be set up. This decision would be based on a wide variety of factors. Globally, MCL customers were classified according to geographical regions. Africa region was the largest, with MCL present in 5 countries. The company had enjoyed monopoly status in the countries where it operated for a long period of time. From the year 2018, competition has been building up, where some companies have been able to offer more advanced and better products. This has led to MCL's bottom line being impacted adversely. The competitors' products are imported as complete portable sets and do not require local assembly. The marketing model used by competitors borrows heavily on multi-level marketing and therefore embraced by MCL customers. Perception associated with companies such as ML, which sell large quantities, undermines quality selling. The competitors introduce new modes of selling, including hire purchase and loaning for their appliances. These modes were quickly adopted by customers. Peter Quick joined MCL in the year 2020 as the head of sales Africa region. At the time, competition was very stiff and the financial position of the company was very low. Major customers that had remained loyal to MCL were shifting their loyalty. By the year 2021, the competition grew exponentially as new entrants joined in with cheaper and more technologically advanced appliances. Kan Ho, the Global Operations General Manager, whose office is in New Delhi, planned for a brainstorming workshop in the year 2022 for all regional sales heads to advise on the way forward. The regional sales managers were required to provide scientific responses to the problem, guided by facts and the unique challenges in each of their regions. Kan Ho expected that the workshop would yield remedies to the effects of fierce competition and the way forward would be arrived at. In preparation for the workshop, Peter Quick and his team carried out an in-depth internal and external analysis of MCL, studied the competitors' strength, customers' behavior, market volatility, competitors and products differentiation. In the analysis, it was indisputable that some of MCL products were unique and effective in the market. To enable him understand the reasons behind the customer shift in loyalty, Peter Quick purchased some of the competitors' products and shipped them to company's main laboratories in India for detailed analysis of their constituent parts. The laboratory report revealed that 70% of the competitors' products comprised of MCL's products components. The only major differentiating factor was the logo, color, and packaging. Most of the competitors were buying MCL's products, adding on a few improvements, rebranding, packaging, and selling the products in the market as their own. In his presentation, Peter Quick noted that the assignment was complex and weighty. To enable him have a logical presentation during the workshop, he classified his findings in the following categories: marketing strategies, production and operations, human resource, ethics and morals, and legal issues. The workshop recommended certain measures to be undertaken. These measures included: 1. To broaden the customer base. 2. Top management to implement e-marketing strategy. 3. The company to reclassify their customers according to products. 4. MCL to reduce cost of their products. 5. Litigation and court action against companies that had used MCL's patent illegally. By the beginning of this year, the company's bottom line has started showing a positive increase. Customers were trickling back in, and it is expected that by the end of the year, the company will have regained its lost market share. Required, Roman 1. Discuss 3 possible reasons why MCL engaged in the services of a business analyst. That is the question. I must give you an opportunity to retrieve. B of the question reads: Evaluate 4 internal factors that would have played part in impacting on MCL's bottom line. Part C of the question reads, examine 4 ways in which MCL could apply Michael Porter's generic competitive strategies to regain its competitive advantage. Part D, Roman 1. Identify the leadership style applied by Kanho in the case. In paragraph 6, the fact that Khan has planned a brainstorming workshop and seeking innovation shows he's a transformational leader. Transformational is derived from the term transform. So a transformational leader is one who does what? Who motivates and inspires the workforce to achieve extraordinary outcomes. We generally refer to them as visionaries. Transformation leaders are visionaries. Betty says democratic leader because he involves the followers through brainstorming. That is also true. A democratic leader is one who, before making decisions, he allows for participation from subordinates. So he's a democratic leader or participative. Democratic. So a transformational leader also has democratic attributes. Participative. You may say democratic, participative, transformational. That is the style. So you are just required to identify the style without explaining reasons. Okay? Without giving reasons. Because it's just a mark. In Roman 2, analyze 4 characteristics of the leadership style applied by Khan in D1 above. Characteristics. So you are just to state the style. Then in Roman 2, you give the characteristics. Corey says involves employees, subordinates in decision making. True, that is true. Involvement. The key word there is involvement. Involvement. Collaboration and involvement. That is true. Involvement. Involvement and collaboration. And that we can prove from the case. Okay, we can prove this point from the case. Kanho demonstrated a collaborative approach by organizing a brainstorming workshop for all regional sales heads. And that allowed them to do what? To share the insights, experiences, and suggestions, which then fosters a sense of ownership and involvement in the decision-making process. True. Kidiga says visionary. Visionary. I can easily critique your point, Kidiga, because if Kanho is visionary as you are stating, then how come he didn't see, because a visionary is one who has a picture of what will happen. How come he didn't foresee the stiff competition and take proactive measures to cushion the company against the effects of competition? Because putting together a team to to brainstorm so that the company can be saved from the current situation may also indicate that he failed in a way to see the place in which the company is now. You understand? Does that not contradict? Because why is this manager organizing a brainstorming workshop for all regional sales heads? Is the manager not reacting? Because a visionary leader is one who is proactive. This one is reacting because the bottom line has been negatively impacted. And we've seen the factors that could have played part in impacting the bottom line. The profit has gone down. Inferior products, ineffective marketing strategies, lack of local expertise. That does not describe a visionary or forward-looking. The purpose, Kidiga, for this brainstorming session is not to avoid future challenges, as you are putting it, but to avoid the current challenges. You understand my point? Open communication. A democratic leader communicates openly. Let me say communication. Open communication. Then I support it. Can encourage open communication by doing what? By requiring the regional sales heads or managers to provide scientific responses based on facts and unique challenges in their regions. And that candidates created a platform for honest, open communication. You understand? People brought in diverse perspectives. The managers discussed their deeper understanding of the issues they face in different markets. So a democratic leader encourages open communication. A democratic leader also values input. A democratic leader has value for input. Value for input. Value for input. Value for input. And we saw that Kanho valued the input of the regional sales managers. He recognized that they had valuable knowledge and expertise regarding the respective markets. So by seeking their advice, he showed respect for their opinions and demonstrated willingness to learn from the experiences. So that is an attribute of a democratic leader. There's also the aspect of decision making, which is an attribute of democratic leadership. There's what we call shared decision making. We know a dictator or an autocratic leader does not involve employees in decision making. That is the opposite of democratic or participative leadership style. And we see that Kanho was the global operations general manager. While he was the global operational general manager, he did not make decisions in isolation. Instead, he facilitated a workshop where everyone could contribute ideas and collectively arrived at solutions. And in fact, that then empower the team, that boosts morale, and also enhances quality of decision making. So these are 4 characteristics of the leadership style applied by Ho Kan. Part E of the question reads, explain the type of thinking that Peter Quick used to address the problem. What is your view? Corinne says analytical thinking. R says analytical thinking. Corinne says Peter carried out an in-depth internal and external analysis of MCL. That is correct. Someone says he came to understand the reason for change in customer loyalty and analyzing competitors' products. So we have Roman 1 and Roman 2. Now, apart from analytical thinking, what thinking comes to your mind? Apart from analytical thinking, which involves breaking down components of an idea or something, all right? Then analyzing the components with a view of understanding it, all right? Other than analytical thinking, Peter Quick must have used analytical thinking to address the problem. Because, analytical thinking involves breaking down complex problems into smaller, say, manageable parts. And the purpose of breaking them down is to understand their, say, underlying causes, and then develop solutions. That is to say, analytical thinking is a logical approach to solving problems. And that is true. Peter Quick used analytical thinking. My question is, could there be any other type of thinking that he could have used? So the one who says analytical thinking and supports the type of thinking using the facts of the case may score the marks. The one who says critical thinking and you can support the type of thinking. So you have 3 thinkings. 3 thinkings. Analytical thinking, critical thinking, and strategic thinking. Any other thinking? If you have studied, what do you call it? Development of risk management thought, you must have covered something to do with the systems theory. Heard about it? Systems theory. From it we can have, someone says concrete thinking. Have you heard of systems thinking? Systems thinking. Systems thinking, which is a holistic approach. Systems thinking, candidates, is a holistic approach to analysis that focuses on the way a system's component parts interrelate and how systems work over time. You understand? Because a system, as we know it, is a group of elements or components that work towards achieving a certain goal. So we may talk of education system, a political system, generally speaking. Okay? So system thinking is a holistic view or approach to analysis. For Peter Quick had to analyze a problem. So he may have used systems thinking, which focuses on the way system parts, because we said a system is a group of components. In a system, there are parts that interrelate to either solve a problem or to achieve a certain end. So instead of concentrating on individual components of a system, system thinking examines the system as a whole, recognizing that the behavior of the system cannot be fully understood by simply analyzing its parts in isolation. Do you understand? So systems thinking emphasizes the importance of understanding the relationships and interactions between the components, as well as what we call the feedback loops that exist within the system. Now, to help you understand what I've just said, you may consider maybe the human body. The human body, as we know it, is a complex system with various organs, with various processes that work together, that makes this organism function the way it ought to function. So when one organ malfunctions, when one part of this system malfunctions, it affects the whole body. For example, if I have a problem with my brain, if my brain does not function accurately, the way it ought to function, it will affect all the parts of the body. Because I rely on my brain to tell me what to do. Okay? I rely on my brain to look for food, to feed the stomach. Because if the brain is not functioning well, then the stomach may not receive the food. You understand? Another part could be, say, the pancreas. All right? For example, a problem with my pancreas can lead to diabetes, which then impacts the entire metabolism. Now let me come home. A business. A business, likewise, is a system. It has departments. A business has employees as another component. We have processes that interact. The departments, marketing department, production department, IT department, we have research and development department, we have the management. So those parts, within those departments, we have people, we have processes, we have procedures, we have rules, we have manuals. So candidates, a change in one area, e.g. marketing strategy. If you change the marketing strategy, that change in marketing strategy can affect sales. That strategy can affect customer satisfaction, and ultimately it can affect company's profitability. So the type of thinking, in my view, is the systems thinking. He used the systems thinking. So if use the system thinking, the type is system thinking. Then what are the steps followed in the systems thinking? One step is to identify what we call interconnectedness. Interconnectedness. I just defined a system as comprising many components or parts that interrelate to achieve a certain end. So the first step in system thinking is to identify in system interconnectedness. Identify interconnectedness. So let's come back to the case. Let's come back to the case. Now, candidates, Peter Quick recognized that challenges faced by MCL were complex and interconnected. Were complex and interconnected. All right? Peter Quick. I'm looking for Peter Quick. But why do I say so? I say so because he understood that the problems in marketing, the problems in production, the problems in human resources, problems in ethics, the problems in connected with the legal issues were all interconnected. They were all intertwined and needed to be addressed holistically. Okay? So the first step in system thinking is to identify interconnectedness of things, how things are related. You understand? So that's step number one. Identifying system interconnectedness. Identifying system interconnectedness. Now, the second stage or step is understanding what we call feedback loops. Understanding feedback, understanding feedback loops. And how did Quick do that? Now, Peter Quick investigated the feedback loops within the company's operations. For example, he analyzed how the decline in sales was impacting the company's financial position, which in turn affected employee morale and customer loyalty. So by understanding feedback loops, he could identify what we call leverage points of intervention. You understand? So that is the second step. Hope you can hear me. Now the third step is analyzing root causes. Analyzing root causes is the third step in the system thinking process. Peter Quick had to just go beyond the surface level symptoms. You had to dig deeper to uncover the root causes of MCL's problems. We read, to enable him understand the reasons behind the customer's shift in loyalty, Peter Druck purchased some of the competitors' components, products, and shipped them to the company's main laboratories in India for detailed analysis. All right? So he went beyond the surface level symptoms. He bought the products from the competitors and then shipped them to India. You understand? And that helped him to understand the true nature of the competition and the need to protect the company's what we call intellectual property. Because after carrying out an in-depth analysis of these products, we read that 70% of the competitors' products comprised of MCL's products components. So these competitors were buying the company's components, then reassembling them. Then they were just changing the logo, the color, and the packaging. So you can see here, he analyzed the root causes of the problem. Lastly, we have what we call long-term consequences. Long-term consequences. In systems thinking, one has to consider long-term consequences. One has to consider long-term consequences. And why? How can I support the step on considering long-term consequences? Now, in making recommendations, candidates, making recommendations, because the last paragraph here we read that the workshop recommended certain measures to be undertaken. One is to broaden the customer base. Number 2 is top management to implement e-marketing strategy. Number 3, the company to reclassify their customers according to products. Number 4 is to reduce cost of products. Number 5 is litigation and court action. So Peter Druck's recommendations were not just quick fixes, but they aimed at long-term solutions. And he advocated for broadening the customer base, implementing e-marketing strategies, reclassifying customers, reducing costs, taking legal action against patent infringers. And such actions are designed to address the underlying issues and create sustainable competitive advantage for MCL. So that's the answers to the case study that was tested in August 2023. I think I've exhausted my time. I may not have time to do another question. Maybe we can create time tomorrow to maybe do the other questions or any other case study. If you have a question that you'd want us to look at here, please feel free to communicate in our WhatsApp group. Bye-bye.
Yes, good day, my student. Welcome back to Manifested Online Classes. My name is Joseph Kimani. And in this session, or basically in this class, I want us to look on an illustration question regarding the topic of public financial statement. Remember, in our previous classes, we have already looked on how we prepare the statement of comprehensive income, statement of financial position, statement of changes in equity. And in this class, I want us to illustrate how we present the same using a past paper question. I want us to go through the question, and then from there we look on what was required. So the question reads, the following trial balance related to BD Limited as at 31st of December 2022. So we are given a trial balance for BD Limited at the end of the year. First of all, we have the property at cost, and you're told property include building. Generally, if you're given property include land and building. So in our case, you're told the value of building is 400 million. So mean that the difference between 600 and 400 is the value of land. We have plant at cost, motor vehicles at cost, office equipment at cost, accumulated depreciation as at 1st January 2022 for buildings, plant, motor vehicles, office equipment. And then we have the inventory at the start of the year, purchases at cost, distribution cost, administrative expenses, revenue, trade receivables, and trade payables. We have the bank balance. We have the deferred tax, current tax, bank interest, and then from there we have the ordinary share capital, the share premium, the retained profit as at 1st January 2022, interim dividends paid, and then we have suspense. Then from there we have some additional information, note number 1 up to note number 6. And then what are we required? We are required to prepare the statement of, we are required to prepare the following financial statements in a suitable format for publication. In other terms, we are required to prepare 3 components here of financial statements in a format suitable for publication. 1, we are required to prepare the statement of profit or loss for the year which ended 31st of December 2022. B, a statement of changes in equity for the year which ended 31st of December 2022. And C, a statement of financial position as at 31st of December 2022. Now, before we prepare what was being required here, definitely we need to go through the additional information. We see what we are told, and equally we see whether there is any working which is required. So in additional information number 1, you are told, during the year which ended 31st of December 2022, BD Limited disposed of an item of plant for cash proceeds of shillings 20 million, which were credited in the revenue account, and we are told no other accounting entries were made. The plant had a cost of 39.7 million and had an accumulated depreciation of 15.86 million. And then in the other point, you are told any gain or loss on disposal should be included within the cost of sale. So what you are told here is that this company disposed, or in other terms, sold an item of plant at an amount of 20 million. So this 20 million, which was received from the sale of the plant, we are told it was included as part of the revenue. First of all, that is wrong, because whenever the company sells an asset, that is a capital income. It should not be included in the revenue of the company. So therefore, when preparing the statement of profit or loss, what we are going to do, from the figure for revenue, we are going to less that 20 million. 2, anytime the company disposes or sells an asset, you have to prepare an account called disposal account for you to determine whether that item was disposed at a gain or at what? At a loss. And actually, we are told that profit, all the loss on disposal should be part of what? Part of the cost of sale. So therefore, let's start with that working. Remember, this illustration. This is illustration on the topic of published. So we start with the workings. We start with workings, and working 1 will be the preparation of the disposal account. I've said this is an account which is prepared anytime the company do what? Sells or disposes an asset, and we prepare this account to determine whether the asset was disposed at a gain or at what? At a loss. So how do we prepare this account? We prepare this account by debiting it with a cost, crediting it with 2 items, the accumulated depreciation and also the sales proceed. Then from there we balance our account. Any balancing figure on this side is a loss on disposal. Any balancing figure on this side is a gain on what? Disposal. So we are given those items, One, we are told, we are given the cash proceeds. The cash proceeds is the amount which was received by the company after selling that asset. And if you check on the figures given in the trial balance, our figures are given in thousands of shillings. So therefore, for us to be consistent, we have to work with all our figures in thousands of shillings. So 20 million is the sales proceeds. And then we are also told that this plant had a cost. The cost was 39,700. That is a cost. And then we also given the accumulated depreciation as 15. Okay, that is the accumulated depreciation we recorded up there. 15 what? 15,860. So what we need to do, we balance our account here, and the balancing figure, if on the debit side is a gain, if on the credit side is what? If on the credit side is a loss. Is a loss. So let's add what we have on the credit, 15,860 plus 20,000. So that will give us 35,860. So mean that this side is more, and therefore our balancing figure will be on which side? It will be on the credit side. And how much will be our loss? It will be, we take that minus what we have on the debit, 39,700, and that will give us 38 what? 40. So this particular 38.40, this is what? This is the loss on what? The loss on disposal. And what you're told is that this particular loss on disposal should be included as part of the cost of sales. And basically that's what we said in our previous class, that any gain or loss on disposal should be part of the cost of what? Sales. So that will be added in the cost of sales. And equally, we have said as far as that point is concerned, there are a number of adjustments we are going to make. The 20 million, this is the amount received from the selling that particular plant. We are told it was included as part of revenue. That is wrong. We are going to less that from the revenue. And then we also told that this particular plant which was disposed or which was sold had not been accounted for. What the company had accounted for is purely the amount received. And therefore, this plant which was disposed, we are going to less it from the plant of this company. The moment the company sells an asset, disposes an asset, such an asset should be derecognized. It should be removed from the company's books of account. That was not done. So therefore, we are going to make that adjustment, but you're going to make that adjustment specifically when preparing what is required in Part C. So let's move to the last point of note number 1. And you're told it is a policy. It is the company's policy to provide a full year depreciation in the year of asset purchase and none in the year of disposal. It basically means that whenever the company has acquired an asset in a certain year, even if the asset is acquired some few months to the end of the year, the company provide a full year depreciation, but no depreciation which is provided in the year of disposal. Basically, that information is to help you in terms of computing the depreciation for plant in note 2, because there was this plant which was disposed during the current year. So this plant which was disposed during the current year, no depreciation will be provided as far as that plant is what? Concerned. But you're going to use that information in note 2. So let's go to note number 2. And you're told depreciation on property, plant and equipment is to be provided and allocated as follows. So let's compute those particular depreciations. As per note number 2, we compute the depreciation of items of PPE. We start by computing depreciation of the first item, which is what? Which is buildings. Buildings. So we are told buildings are depreciated at the rate of 2.5%. Using which method? Using straight line. So at a straight line, you have to recall we compute depreciation based on the cost. So what is the cost of buildings in the trial balance? The cost of buildings is 400 million. So we get 2% of 2.5% of that, 2.5% of that. And then also in note number 2, we compute the depreciation on plant, which is at the rate of 10%. Using which method? The reducing balance method. So under the reducing balance method, we compute depreciation based on what? based on the net book value. Based on the net book what? Value. So what will be the net book value of a plant and the plant? So we take the cost, which is 280, and then we less the accumulated depreciation, which is 111, 116, 1 what? 16. But now equally here, you have to remember there was this plant which was disposed. So therefore, because no depreciation which is provided in the year of disposal, we automatically need to eliminate that particular plant here. That plant here. And basically we eliminated here at its net book value. So what will be the net book value of that plant? So the net book value of this plant which was disposed will be, its net book value will be equal to its cost, which we have here, 39,700 minus the accumulated depreciation, which is 15,860. So that will give us now the net book value of this particular plant which was disposed, which was sold during the current year. We have 39,700 minus 15,860. So that will give us a net book value of 23,840. So because it's part of this and we are told no depreciation in the year of disposal, we need to deduct it there, 23,840. And basically you can see we are deducting it there at what? At net book value. So we are going to come back and compute these particular depreciations. Then let's go back to note number 2, depreciation on motor vehicles, which is at the rate of 20%, using which method? Straight lines. At a straight line, we compute depreciation based on cost. The cost of motor vehicles is 70 million. 70 million. So we will compute that. We go back to note number 2. We compute depreciation on office equipment. Office equipment, which is 12.5%. Using straight line. Straight line, we compute depreciation based on what? Based on the cost. Based on the cost. Yes. So what now we need to do? We compute these particular depreciations. And remember in our case here, what you have said is that depreciations on items of PPE, this one is included as part of the cost of sales unless told otherwise. If you go back to that particular point, you'll be able to see how those particular depreciations are supposed to be classified. For example, depreciation on building is administrative and so on. But you have said if the question is silent, you always account for this depreciation as part of the cost of sales. So let's compute this. We start with the depreciation on buildings, which will be 2.5%. 2.5% times 400,000. 400,000. So that will give us what? That will give us 10,000. Will give us a figure of what? 10,000. 10,000. And then you are told that this particular depreciation on buildings, as per note number 2, this one will be part of administrative expenses. Will be part of the administrative what? Expenses. That is important. Then let's compute the depreciation on plant. First of all, we compute this, and this was a figure of 280,000. This is a 280,000. 280,000. I hope that is correct. 280,000. Yes, we take 280,000. 280,000 minus 111, 160. 111, 160. I hope that also figure is correct. 111, 160. So and then to this we less now the net book value of the plant which was disposed, 20. Okay, and then we get 10% of that, which will give us 14,500. 14,500. How is this depreciation to be accounted for? As per note number 2, this will be part of the cost of sales. This will be part of the cost of sales. Then let's compute the depreciation on motor vehicles, which is 20% of the cost, which is 70, and that will give us 14,000. As per note number 2, this depreciation on motor vehicle should be classified as part of distribution cost. Part of distribution cost. Then we compute depreciation on equipment, which is 12.5% of the cost. Of the costs. the cost, and this will give us what? 5,000. And equally as per note number 2, this is a part of admin. This is part of the administrative what? Expenses. So those are the depreciations. So, and I think we are done with that particular point. Let's move to point number 3. In point number 3, what are we told? We are told that it has been discovered that the former financial controller of BD Limited engaged or basically was engaged in fraudulent financial reporting of shillings 12 million of trade receivables that were non-existent and need to be written off. So basically what that means that the former financial controller of this company included in the receivables an amount of 12 million which are non-existent receivables, and therefore they need to be written off. So we are told that out of this amount, 7 million relate to the year which ended 31st of December 2022, which is now the current year, and therefore that particular amount of 7 million which relate to the current year, we are going to write it off and basically include it as an expense for the current financial year. So remember, these bad debts which are written off, this is written off as a result of a decision which has been made by the board or basically by the management, and therefore such an expense which arises as a result of a decision which is made by the management of the company, by the board of directors, then we classify that as part of administrative what? Expenses. And then you're told with the balance relating to the prior what? Year. So therefore, those particular bad debts which are to be written off, which are for non-existence receivables, bad debts written off, So in that case, we are told that is an amount of 12 million. Is an amount of 12 million, but we said we are working with all our figures in thousands of shillings. So we are told 7,000 relate to the current year. So therefore, in preparing our income statement, this one we are going to include it as part of admin. And then now the difference, which is 5 million, this one is a prior year adjustment. Adjustment. Basically what that means, this amount of 5 million, it related to the previous year. We don't include it in the income statement for the current year. It's not an expense for the current year. So what we do, we adjust it in the opening the opening retained profit or the retained earnings, because it was an amount which was supposed to be written off in the previous years, but it was not written off. So what we are only including in the income statement for the current year is 7 million. So let's go to note number 4. And in note number 4, we are told the existing debit balance on the current account in the trial balance represent the adder or over provision for previous year's tax. So if you go back to the trial balance, there is an item which you are given there, which is an item of current tax. So that item is below the bank balance, is below the deferred tax, and that item is an amount of 2600, the item of current tax, and you can see this is a debit balance. It is on the debit side of the trial balance. So this particular amount here, this one is what? Is under provision. Of what? Of current tax. Because under provision of current tax from the previous years has a debit balance, in the trial balance. But if it was over provision will be having a credit balance. That is something which the examiner will not tell you, but any other provision of current tax from the previous year, this one will always be having a debit balance in the trial balance, and any over provision of current tax in the from the previous year, this will be having a credit balance. This is something you'll come across in most of the questions for published, but the examiner will not have specified whether it is over or other. Is upon you to know that other provision has a debit balance, other provision has what? Has over provision has a credit balance. So therefore, that is over that item which we have is under provision. So how do we treat under provision of a current tax from the previous year? So such under provision, we bring it forward to the current year and we add it. We do what? We add it to the current year's estimated tax liability. We add it to the current year's estimated tax what? Liability. But if it was an over provision, we bring it forward to the current financial year and we less it from the current year's estimated tax what? Liability. That's basically what you need to know, and therefore that's what you are going to do as far as that under provision is concerned. And then you're told, number 4, the second sentence, we are told the provision for current tax for the current year, that is the year which ended 31st of December 2022, was 42 million, or was 52 million. 52 million is required, together with a decrease to the deferred tax provision of 3 million. So therefore, we are told the estimated tax liability for the current year is 52 what? Million. So mean that we need to determine the amount of current tax to be charged in the income statement. So the amount of current tax to be charged in the income statement, what we do is that we take the current year's tax estimate, which is 52 million. But remember, in the previous year, we had under provision. The other provision which we have in the trial balance of how much? Of 26. And you have said that that other provision from the previous year, we added to the current year's tax what? Estimate. And this will give us now a total of 54,600. So this is the amount of current tax to be charged in the income what? Statement. In the same point, we are told there was a decrease in deferred tax provision. A decrease in deferred tax provision in the income statement, that one is accounted for as a deferred tax income. As a deferred tax what? Income. So because it's a decrease, just the same way how we account for a decrease in provision for doubtful debt. A decrease in provision for doubtful debt, we account for it as an income. But an increase in any provision is accounted for as an expense. So therefore, that amount of 3 million, that is a deferred, tax income. A deferred tax income of how much? Of 3 million. Remember now these two items will be adjusted in the profit before tax. That's what we said in our previous or in the introduction class, that to the profit before tax we adjust two items, the current tax and also the deferred tax income, or what? Or expense. So we have that. Then let's move to the other note, note number 5. And note 5, we are given the inventory at the end of the year. This is now the closing inventory, no working which is required. And then number 6, you are told on 30th of December 2022, the company directors invited the current shareholders to subscribe for a right issue on the basis of 1 share for every 5 shares which were held at an exercise price of 15. And then you're told the come right price on the last day of trading was 20 shillings per share. So, and then you're told the proceeds from the fully subscribed right issue were credited in the suspense account. So I think what we need to do there is to determine how many shares were issued by the company during the right issue. How many shares were issued by the company during the right issue? So we are told this right issue which was made by the company to the existing shareholders, it was on the basis of 1 share, 1 share for every 5 shares held. For every 5 shares which were held. So what we need to do first of all is to determine the shares held by this company, not held by this company, but the shares held by the members, the shareholders of this company. How do we determine that? We take the ordinary share capital of the company, which is given in the trial balance, which is 200,000. And to determine now the shares issued by the company, we divide that with the par value. The par value is the value per share given in the trial balance, which is 10. And this will give us 20,000 shares. So these are the shares which were held by the shareholders of the company. So the company was to, during the right issue, was to issue 1 share for every 5 shares which were held. The shares which were held were 20,000. So we need to determine how many shares were issued during the right issue. We take 1 times 20,000, we cross multiply, then we divide. Divided that with what? With 5. So this will give us what? 4,000 what? Shares. And we are told that these shares were issued at an exercise price of 15. So therefore what we need to do, we multiply the 2, and basically this will give us the amount which was received by what? By the company. The amount received by the company from the right issue, which automatically this one will give us what? 60,000. Now what we are told is that this particular amount in the last sentence of note number 6, the proceeds, the amount received by the company was credited in the suspense. Was that correct? No. Because what we know is that once the company make a right issue, the amount which was received should be debited in the bank account, debited in the bank. That entry was made, but now the company credited suspense account. Is this what the company was supposed to do? No. So because these are shares which were issued, this account is not the one which was supposed to be credited, but the company was supposed to credit which account? The company was supposed to want to credit the ordinary share capital account. The amount credited in this account is always based on the par value per share. You take the shares issued by the company, 4,000, times the par value. The par value is the amount or is the value per share we have in the trial balance, which we know is 10. So the amount to be credited in this account will be what? 40,000. So this amount of 40,000, we are going to add it to the ordinary share capital of the company. And then the amount which is above 10 shillings. You remember the shares were issued at 15. The amount which is above 10 shillings is a premium. So therefore, that will be credited in which account? The share premium. The shares issued, 4,000 times what? 5. Times 5. Times 5. So the total, which is 20,000, that is a share what? A premium. So therefore, the adjustment which will be made as far as that note is concerned is that when preparing the statement of changes in equity, to the ordinary share capital, we are going to add 40,000. To the share premium, we are going to add what? 20,000 in relation to these particular shares which were issued by the company during the current year. And I think we are through now with the notes. What we need to do, basically we can proceed and prepare what is required. So let's start with part A of that particular question. And what is required is the statement of profit or loss. So first of all, we need to have the name of the company. The name of the company is BD Limited. And this is a statement of a profit or loss. Statement of profit or loss for the year which ended 31st of December 2022. 31st of December 2022. So that is basically our title there. Our title. And then now we have to use the format which I gave you. Remember, I gave you the format for this. That is the exact format we use here. So, and remember, all our figures are in thousands of shillings. And here we only have one column. So what do we start with here? We always start with the revenue. The revenue. And the revenue is something which is given in the trial balance. The revenue for this company in the trial balance is given as a figure of what? As a figure of 11,23,500. But remember, there is an adjustment which you are going to make here as far as note number 1 is concerned. So this plant which was disposed by the company, we are told this amount which was received, the sales proceeds, this was included as part of the revenue. Yes, so to this figure, we need to less 20,000, which was included here as the amount which was received from selling the asset. That amount should not be recognized as a revenue because this is basically a capital income, a capital revenue. So any amount realized from the selling an asset should not be included here. So I think that now will give us a figure of what? A figure of 11,03,500. So, but we can confirm that. Let's confirm whether that is correct. So we have 11,23,500, minus 20,000 minus 20,000, that will give us 11,035 what? 500. And then to this, what do we need to do? We need to less the cost of sales. We need to less the cost of what? The cost of our sales. Cost of our sales. Now, are we given the cost of sales? No, we have to compute it. Remember, I gave you the formula for computing this. We take the opening inventory plus purchases minus closing inventory plus any depreciation plus any loss on disposal minus any gain on disposal. So what we include here, one is the opening inventory, which is given in the trial balance, 138,000. To this we add purchases, which is just below the opening inventory, which is 667,000. To this we less the closing inventory. Where do we have the closing inventory? Note addition information number 5, which is an amount of 85,000. And then to this we add any loss on disposal. Remember, here we have a loss on disposal, which is 3840, and any depreciation on PP. We have various depreciations here, and part of them should be included as part of the cost of sales, starting with the depreciation on plant, which is 14.5. Do we have any other depreciation which should be included as part of the cost of sales? No. So that's how we are going to arrive at the figure for the cost of sales. Opening inventory, purchases, closing inventory, loss on disposal, and then the what? And then this depreciation on what? On plant. So let's get the final figure here. We get the final figure. So we have what? We have 138,000. 138,000 plus 667,000 minus 85,000 plus 3840 minus 14,500 and that will give us a figure of what? It will give us a figure of 709,340. 709,340. 709,340. So we less that from our revenue up there, and whatever you get here is the gross profit. The gross profit. So how much would be our gross profit? We deduct that from 1103 500, and this will give us a 598,990. That is our gross profit. So to this gross profit, next we said we add other income. So when checking for other incomes, what basically you do, you go back to the trial balance and you check other incomes on the credit side. All incomes, they have a credit balance. So we go through the items on the credit side of the trial balance. We see whether we have any other income. Up there you can see we have accumulated depreciations. Those are not incomes. Down here we have revenue, payables, bank balance, and then deferred tax. And then we have ordinary share capital, share premium, retained profit, and down there we have what? Suspense. So basically in our case here, we don't have any other income. We don't have any other what? Any other incomes. We don't have any other what? Income. So then to this we go straight to deducting our expenses. Our expenses, we can start with just what we have in our trial balance. Below the opening inventory and purchases, we have the distribution cost. Distribution cost. So the distribution cost in our trial balance is given as an amount of 44,000. So there are some depreciation which are part of the distribution, and that is the depreciation on what? On motor vehicles. So that one we included here. And that is an amount of depreciation on motor vehicles is an amount of 14,000. 14,000. So this will give us a total of 58,000. So below the distribution we have the admin expenses, administrative expenses. So equally that need to be adjusted. We can do our adjustment with here. So we have 93,500. So then we need to include the depreciation on what? On buildings, which is 10,000. And then also this depreciation on what? On office equipment, which is 5,000, which is 5 what? 1,000. There is something you should also, we also need to remember to include here. There was this bad debt which was to be written off and which related to the current financial year, the amount of how much? 7,000. We said it should also be part of administrative expenses. Yes. So and I think now we can get the total administrative expenses. We have 93, 500 plus 10,000 plus 5,000, or we can just take 5,000 plus 7, which will give us a total of 12. Yes, and that will give us total administrative expenses of 115, 500, 115, 500. And then below the administrative expenses, I think we have revenue. Okay, we have trade receivables, bank balance, deferred, current, and then we have the bank interest. Now, this bank interest will be included here, but we include it here as part of the finance cost. And I think this is the only item which will form part of the finance cost, and that is an amount of how much? That is an amount of 24. 24. And then now what we need to do is we check whether we have any other expense or this company had any other expense which has not been classified as part of cost of sales, distribution, admin, or what? Finance. So we just go through the trial balance and we check the items which we have on the debit column, because all expenses, they have a debit balance. So first of all, up there we have assets. Those are not expenses. Down there I can see inventory, purchases. Those are not expenses. We have already captured distribution, admin. Down there we have receivables, that is an asset. Down there we have current tax. Remember that was at a provision. That is not an expense. Bank interest, we have already captured that there in our income statement as what? As finance costs. And then down there we have interim dividend. So basically that is not what? An expense. And I think then what we have in the additional information, number one, we had the loss on disposal. We have already captured that as part of cost of sales. Note 2, we have these 4 depreciations. Depreciation on buildings, that was supposed to be included as part of what? Admin. We can confirm whether this has been included as part of the admin. 10,000 is there. Then depreciation on plant is part of the cost of sales. Have we included that here? Yes. Motor vehicles, its depreciation is part of distribution. 14,000. Have we included as part of the distribution? Yes. Office equipment, its depreciation is part of admin. 5,000. Has it been included as part of that? Yes. Okay. And then number 3, we have this amount to be written of 7, which should be part of admin. Have we included that there? Yes. And then number 4 is about tax, current and deferred. That will be deducted from our profit before tax. And then number 6 is all about, number 5 is about closing inventory. We capture that there. Number 6 is about late issues that do not affect our what? Expenses. So basically what that means is that we don't have any other expense. We don't have any other expense. So what we need to do here is we get the profit before tax. The profit before tax. Our profit before tax will be, we take now the total incomes minus the expenses there. So we have 598, 990 minus 58,000 minus 115, 500 minus 2400, and that will give us a figure of what? A figure of 423,090. So that is the profit before tax. And then to this we need to less what? We need to less the income tax expense. Income tax what? Expense. And for the income tax expense, this comprises of 2 components of tax. The current tax. And the current tax, we computed that figure there, which is 54,600. 600. And then we also have the component of deferred tax. What did we have here? We had the deferred tax income. Deferred tax income. And because this is an income, a deferred tax income, we don't less it from our profit, but rather what we do, we add it. We add it. That's why we refer to it as a deferred tax what? A deferred tax income. So we take our figure here, which is 423,090 minus 54,600 plus 3,000. And that will give us 371 for what? 490. So what is this? This is the profit for the year. The profit for the year. So to this profit for the year, we said then we proceed and we add other comprehensive incomes. Other comprehensive what? Incomes. Other comprehensive incomes, we said these include revaluation gain or loss on PPE, revaluation gain or loss on a financial asset at fair value through other comprehensive income. But if you check on what we have in this particular question here, we don't have any other comprehensive what? Income. So basically what that means is that our total comprehensive incomes will be the same with the profit for the year, 371 for what? 490. So basically that is it. That's what was required as far as Roman 1 of that question is what is concerned, or part A of that question is concerned.
Hello learner, welcome to Manifested e-learning platform. My name is F.A.M. Lingwiri, and today, ladies and gentlemen, we are discussing about the financial modeling and data analytics paper, which came in April 2023. The question in focus is question 22. It reads as follows. Let's read together. As a senior financial analyst at Wema Capital, you have